The 2020s didn't start the way any of us expected. Things that seemed so secure at the start of the year seems a lot less sure right now. But every challenge has a seed of opportunity inside it. And this crisis is no different. Now is the time to adjust. I've been through crisis before, several of them. I know that first you survive, and then you thrive. I'm Simon Dixon, and for 20 years, I've been helping everyday people navigate the financial markets. Since 2011, I've helped many invest into the highest performing asset in history, Bitcoin. This time last year, I gave a free 4-part video series on how to build and protect your wealth in the Great Depression of the 2020s. The portfolio since then has outperformed financial markets by orders of magnitude. So now, over the next week, I want to update you on everything that has changed and show you why now is the best time to adjust in the most interesting and exciting time to be alive in financial history. Welcome to the brand new Retirement Plan B live masterclass. Hello, everybody. Welcome back. We're at Masterclass 3. We've hit the halfway point now. So thank you to everybody that's been returning. I last looked at all the different questions that we've got to get through on the Slido board, and by last count, there was approximately 500. So we're going to try and cover some more questions today, and we're live again tomorrow for the final Masterclass, Masterclass 4. And I'm going to cover way more questions tomorrow as well. So let's check in. Let's say we're all, let's check everything is going okay. If you can hear me, please state so in the live chat if you're watching on YouTube. But remember, the best experience is if you head over to retirementplanb.com, because that's the only way you can get your questions asked, where we're going to be taking all of your questions. So if you haven't registered at retirementplanb.com, just enter your real email. We're giving you all notifications, all bonus content will be going to that email, and it will take you through to Masterclass 3, where you can see this video, and underneath it, you'll see a little board where we're going to take as many questions as we can get through. But before that, there we go. That's exactly what it looks like. They tend to come in throughout the whole session. So let's do a quick review of exactly what we covered in Masterclass 1, 2, and exactly what we're going to be covering here today. So Build and Protect Your Wealth in the Great Depression of the 2020s is a free 4-part video series that I released exactly this time last year to support people in what I call the Great Depression of the 2020s. In video 1, we went through exactly what I mean by that, and we had inflation, deflation, economic growth, economic decline, which were the exact all 4 scenarios that I was preparing people for, because politics you don't know which one's coming. And so I was sharing, should I buy or should I sell Bitcoin now? And we went through approximately 5,000 years of monetary history as fast as possible to give you the bare necessities of everything you need to know in order to build and protect your wealth in the Great Depression of the 2020s. We then moved over to the live content, and we were sharing everything that has changed, all the return on investment that the investors that implemented had achieved during that 1 year. And we went through all of that. Now, that was Masterclass 1. Now, remember, if you've missed, just play full out, join me here, and be immersed in Masterclass 3. They all build on top of each other, but they're also self-contained. So you can always return back. But by the end of this week, remember, next week, we're going live with the 500 people that will be joining the online wealth management program. And you've got till the end of this week to catch up, go through Masterclass 1, Masterclass 2, Masterclass 3. I promise content rich, and I want you to immerse yourself in setting yourself up so that you can finally get to thinking and building yourself a crypto and Bitcoin focused retirement plan, really focused on the best of everything I've learned over the last 20 years, being involved in investment banking, being an investor, speaking at the first Bitcoin conference. And we'll play a little clip in a bit for those of you not familiar with me, just so you can understand who you're learning from before we jump right into the content. So that was Masterclass 1. Masterclass 2, we covered the lessons and mistake of 7 of the highest profile investors and Bitcoin figures, whether it be Warren Buffett, Ray Dalio, and from Bitcoin figures like mistakes and lessons from Roger Ver and various other people. So if you haven't watched that already, then you get to go back and review that. And remember, repetition is the mother of all achievement. I heard a certain belief about learning, which is that you could academically learn something. I could tell you everything, but it's in the implementation when you know whether you have truly learned. And so my goal in giving you all of this information, all of this content, is for you to go out and put it into action, because nothing happens unless you go out there and do something about it. And so that's we went through that. And we went through the 5 steps of dealing with cryptocurrency taxes in relation to asset protection structures, and things we're going to be diving in a lot more deeper on today. So the topic for Masterclass 3 is we're going to be going through the 5 Bitcoin and crypto investing strategies that I have been using for a long time, that I implemented into a retirement plan live last year, and that I'm still using today. We reviewed them all last time, and we're going to be going through each of those 5 Bitcoin and crypto investing strategies and how they did over the last year. I'll also be going through many of the structuring comments that you have. There's been a lot of questions about, can I put Bitcoin in my retirement plan? Should I have a trust when dealing with my inheritance? And lots of other structuring questions. What happens if I own it in individual? What if I own it with a custodian? Or what if I hold it with a company like Coinbase? Or whether I own the private key, or whether it's all the different setups and various other things. So in the second half of this, we'll be going through much of the structuring. A little bit of housekeeping for those of you that are new here. The 4-part free video series that I released last year was where I invested $1 million of my personal saving with a group of 500 people. And I actually ended up investing a lot more, but we demonstrated it live with $1 million of personal savings. And I also did it with as if I were having no savings, because I don't want you to think that you need to have all the excuses that come through. Whether it's $1 million, whether it's $10,000, whether it's $100, whether it's $1,000, whether it's 10 million, 100 million, you start to hit scaling issues as you go up, as institutional investors know. However, the goal is to give you percentages that matter. And the strategy is the same. Many people think it takes money to make money. I'd just like to let people know that I started originally with over £100,000 of debt. And I built using the very same things that I've been teaching in Masterclass 1 in order to get out of that debt, and implementing everything we're going through in these masterclasses. So we went through that. And then this 4-part free video series that we're going to be reviewing. In Masterclass 1, we reviewed the Great Depression of the 2020s and what that means to investors and everyday people that need to adjust. We are all speculators. You might think I'm not an investor, but if you're not an investor, it just means somebody else is doing your investing for you. And so we've got to become a lot wiser, a lot smarter to survive all of the jargon and all of the changes and all of the rapid pace of what's happening. My goal is to give you simple, easy to understand strategies, language, so that you can implement it and take this away. We also went through how rich investors are investing right now, what to learn from them. That was all reviewed in Masterclass 2. And then today it's going to be about reviewing the 5 Bitcoin and crypto investing strategies that we covered in video 3 last year, and that's going to be covered in Masterclass 3. And then tomorrow we go live for the very last Masterclass. And in the last Masterclass, we're going to be bringing it all together. We're going to be answering as many questions as we can. We've had over 500 build up. So make sure you get your questions, even if we can't cover them today. We'll aim to cover them tomorrow. And you never know, if we can't get through many of those questions, I'll try and find some more sessions. We'll do what we need to do. We're going to try and get through as many of those questions. So make sure that you're asking those, and you can upvote other people's questions. I'll do a bit of housekeeping. But we're going to be bringing it all together in Masterclass 4. Remember, this all builds on top of each other. Repetition is the mother of all learning, and you're not learning until you have put it into action and actually implemented these things. And so also for those that actually want to implement it with me, after tomorrow, we're going to be opening up for registrations for the online wealth management program. We have 500 people that will be joining us. We took on 500 people last year, and we had to close early because there's only 500 of those available. If you want to just consume the free content, the live masterclass, I'm going to be giving you everything I've got. We come from an abundance place. But those of you that just want to implement it live with me, go through everything step by step, and all of my mentors and tax advisors and legal advisors and inheritance planners and crypto experts and Bitcoin prices and all sorts of stuff, then we're going to be opening up for registration for the online wealth management program. 500 spots, and we start next Monday is the first class for those that subscribe and do that. Now, if you're not in a position to do that, I appreciate because of the basic rules of supply and demand, some of you may not financially be in a position to join us, but the live masterclass is designed so that you can go out, put this into action, and then maybe if you put this into action, if you're anything like the people that implemented the free masterclasses last year, they're now in a position where they can join the online wealth management program, and maybe that's the right thing for you. That's what's going to be happening as of tomorrow. So as we said, if you head over to retirementplanb.com, that's where you can ask your questions. Just you'll see a page, it looks something like this, and you can play the video from within there. And then further down, as you saw on the screen share, you'll be able to get those questions. And all you need to do is put in your email there, and then we'll give you all the notifications of everything that's happening next, how you can join those 500 people on the online wealth management program, and any sessions that we put on in order to get all your questions answered. There you go. This is what it looks like. So you have to head over there to get your questions answered at retirementplanb.com. Just enter your name and email on this page, and then you will be notified of everything that comes next. Also, as a little carrot, for those of you, that if you're new to this, then what we do is, as a reward for joining the live session, we play some bonus content right at the end of this session from some of my expert advisors that make up and give content. And that's a sneak peek inside the Retirement Plan B online wealth management program. And today we have Adam Vaziri, one of the very first crypto lawyers. We co-founded and were both directors of the UK Digital Currency Association way back in 2013, 2014, can't quite remember when it was. But the very first crypto lawyer that I met and has been involved in many of the structuring. We've been working with him for many, many years now, board advisor. So we're going to be playing some of the bonus content from Adam as a reward for those of you. If you're watching the recording, it will be edited out at the end. And so it's only for those that join the live masterclass. And we'll be doing some more bonuses tomorrow in the final live masterclass. Okay. Now, just the final part, I'll move over shortly to a quick video for those of you that don't know who I am, a quick video of what other people and my experiences over the last decade being involved, having spoke at the first Bitcoin conference. But I can't give you financial advice. I did my qualifications in financial advisory, and I know that I need to sit down with you individually one-to-one and understand a lot more about individual situation in order for that to work. So you can't see this as financial advice. This is for educational purposes and to empower you to give you the tools. However, I will be sharing much of the financial advice that I use in building my Bitcoin and crypto-centered retirement plan. I also can't give you individual investment advice. Today, I will be sharing the 5 strategies that I use. So rather than me saying, this is the tip that you should be investing in, and if you watch Masterclass 2, you'll know my thoughts on, coming at all the people that are looking for tips from gurus and all sorts of stuff. I'm going to be sharing with you the exact strategies that make up my retirement plan B. And you are free and welcome to borrow them, go out and implement them, go out and use them. But I can't give you individual investment advice on exactly when to pick, when to buy this one, when to sell that one, and various other things. Because this is for educational purposes. Final 2 disclaimers. I can't give you tax advice. I'm not a qualified tax advisor. I just pay an awful lot of money to qualified tax advisors. And I will share with you some of the things that I do to optimize the tax deferral and various other things in this structuring through asset protection structures. There's a ginormous benefit to asset protection structures, and that's you end up deferring. And for those of you that were in Masterclass 2, you'll know the $1 million difference that it makes by just simply doing things in a more deferred way because of those asset protection structures and retirement planning structures. And finally, although we will be going through structuring, I'm not your lawyer. I can't give you legal advice. However, I can share with you exactly the legal structures that I've spent a long time trying to figure out and spending hundreds of thousands, if not millions of dollars, putting these together. And I'll be sharing with you the exact structures that I use and that we go through and with all of our Retirement Plan B online wealth management programs and the various other things that you can do to implement those and automate those as well in this session in Masterclass 3, but I'm not your lawyer. So just before we jump into the 5 Bitcoin and investing strategies, for those of you that may not be familiar with you, I'm going to move over to the live chat. So if you're in the live chat on YouTube, tell me where you're tuning in from. And you can have your tab open because we're going to be taking all the questions on retirementplanb.com. But if you're in the live chat on YouTube, I'm just going to go over there. We can have a quick chat if you're very familiar with who I am. But if you're not familiar with that, we're just going to play a quick video because I think it's very important in terms of when deciding whether to listen to me or not. Here's what some other people have said. So that you can decide whether this is attending the whole live masterclass session 3, because many of you have been sharing. And I really appreciate all the likes, all the shares, and all the people that have been sharing this with as many people as possible. We'd like as many people to gain access to this information so that they can be implementing this and building, protecting their wealth in the upcoming monetary renegotiations, Great Depression of the 2020s, and some of the investment strategies and various other things that I'll be doing. So I'm going to head over there. And Dave, over to the video.
Volatility that we have seen in the cryptocurrency over the past 12 months. I mean, you're a former investment banker, a trader as well. Would you recommend investors out there to buy Bitcoin?
Well, I believe that there's a lot of untapped value.
Simon Dixon, from the co-founder, lead investment advisor to Bitcoin Capital, the co-founder of BnkToTheFuture, one of the most preeminent investors in blockchain Bitcoin technology of this century. Simon Dixon, tell us about what's happening here.
The best investment banker in Bitcoin. So I thought you'd be the perfect person to talk. Obviously, Bitcoin, digital currency.
His name is Simon Dixon, and he is an OG for sure.
Simon Dixon has been around for so long in the space, since 2011, and was actually at the first Bitcoin conference that ever existed, along with people like Eric Voorhees, myself, Roger Ver, and some crazy people. The stories he told were epic.
Simon's an early investor in Coinbase, in Kraken, in Bitfinex, in blockchain.com, in Robinhood, in Circle, in Ripple. I mean, it's just this rock star lineup of companies that you found and got in early.
Our guest today is Mr. Simon Dixon, who's the CEO of BnkToTheFuture. He formerly worked as a stockbroker in the city. I used to work in the city too for many years. So Richard Branson has said that I like the goals of BnkToTheFuture, where everything is transparent and people can see what happens with their money. Welcome to London, Mayor.
First up is Simon Dixon, a former investment banker and economist. He is also author of BnkToTheFuture, Protect Your Future Before Governments Go Bust. And he's also the CEO and founder of BnkToTheFuture.com. He blames the banks for the global recession, but cautions against investing in gold.
See why you have a show. You said it better than I did.
This traditional financial system is a Ponzi scheme, is going to collapse. A lot of people are going to get hurt. And we need an alternative system to hedge your bets.
So always remember, you are alive at one of the most interesting times in financial history. It's going to be really hard for some, great for others, and I want you to be on the right side of that change. Peace.
Okay, blush, blush. Now everybody knows me. We're going to be moving straight into the content now. Let's go back a slide. We're going to be covering now a review of the 5 Bitcoin and crypto investing strategies that make up the Retirement Plan B. So what we're going to be doing is we're going to be heading over to a quick section of the video series that we released this time last year. And remember, even if you watch them, it's still worth reviewing because repetition is the mother of all implementation and learning. And so we're going to be going through that right now. And so then I'm going to be reviewing each strategy one by one and moving over to some of the questions before we cover all of the structuring as well. So now let's move over to the very first section that leads us to strategy 1. And that is understanding how you combine the Bitcoin and crypto investing strategies with the 4 different types of seasons that you need to be prepared with using the traditional market. So we'll play the video right now, and then I'll come over and review and give you some more commentary on why I think this is important. Okay, Dave, let's play the first section.
Welcome back. Simon Dixon here again with video 3. In video 1 of this 4-part video series, we discuss my belief that 2020 is the start of the next Great Depression, leading to a new global monetary renegotiation. If you have not watched that video, please click the link on this page and start there, as each video builds upon each other. In video 2, I shared what I believe to be the biggest mistakes of 7 of the highest profile investors and public figures in the investment and Bitcoin industry, and the lessons you can take away from them when investing in the Great Depression of 2020. We covered Warren Buffett, Ray Dalio, Peter Schiff, Paul Tudor Jones, Robert Kiyosaki, Tone Vays, and Roger Ver. Now, in video 3, I'll share exactly how I will be investing $1 million of my personal savings in the Great Depression of 2020 to protect myself for the decades ahead, even beyond my personal retirement. I'll also share exactly how I would do it today if I had no savings but a regular income, because this works no matter how much money you have. Then, in the final video 4, I'll share with you how you can implement Retirement Plan B step by step with me and all my advisors over the next 7 weeks with all the additional source that makes it work as a long-term Retirement Plan B. So let's jump right in. First, a recap of video 1. I believe that we are about to have a monetary renegotiation where the largest economies in the world sit around a table and renegotiate the structure of our monetary system, similar to what we saw in 1944, where the modern version of the gold dollar standard was negotiated at the Bretton Woods meeting, or the 1971 debt dollar standard that was announced by President Nixon in the infamous Nixon shock speech. This brings us to an unpredictable outcome that we can speculate on, but preparation for all outcomes is a smart move. Whatever is negotiated around that table will determine the future of our global international monetary system and the value of all your investments. I believe that the economies with the highest gold to gross domestic product GDP ratio will be the ones with the biggest vote at the table, and that will be Russia, China, US, and Germany representing Europe. I speculate that it will involve central bank digital currencies being issued backed by the deposits of bankrupt banks as a result of massive unemployment and bankruptcies, but we'll save that for another video. So how is an investor meant to invest in such a time? The answer is prepare for everything. We discussed the importance of the US dollar and dollar-denominated assets, gold, and Bitcoin in video 1. The good news is that all the tools that one needs to prepare are available to everybody. If you have savings or a regular income to contribute a set amount each month, then the tools are available for you. Only today are such tools so easily accessible to most, no matter how wealthy you are or where you live. So now you can use the lessons we discuss in this video and use the same tools that the largest investors in the world can use to prevent the mistakes that we discussed in video 2. Markets are going to react big time to this monetary renegotiation, and wealth is going to be made and destroyed. Contrary to what many people believe, I believe the monetary renegotiation will eventually get the markets back to business as usual. But the currencies that emerge will take away more of our personal freedoms, liberties, and privacies than we have ever seen before. And as an investor, you need to be prepared for every outcome with a plan to scoop up assets that correct significantly as the monetary renegotiation unfolds. I personally will be using the Great Depression of 2020 and all the market corrections in a once-in-a-lifetime opportunity to accumulate as many discounted assets as I can. I'll be doing this using both the traditional markets and alternative Bitcoin and crypto markets. The first plan is to increase the size of my traditional market Retirement Plan A. So what is a Retirement Plan A? The goal of my Retirement Plan A is to accumulate discounted assets using a conservative traditional portfolio that performs during inflation, deflation, economic growth, and economic decline. The monetary renegotiation could cause all of those outcomes, and I want a portfolio that scoops up discounted assets in every crash and consists of assets that will perform in each of those 4 seasons. I draw inspiration from the person that, in my opinion, is the greatest traditional investor of all time, Ray Dalio. He uses an all-seasons approach to build a traditional investment portfolio using traditional investment products available to all. From backtesting his approach, he's produced extraordinary returns with extraordinary safety and extraordinary low volatility long-term in each of the 4 seasons. His portfolio has survived a Great Depression, 2 World Wars, 2 Gulf Wars, 9/11 terrorist attacks, conflicts in Iraq and Afghanistan, a tech bubble, and the worst financial crisis since the Great Depression in 2008. 25% of a Retirement Plan A should be dedicated to each of the 4 seasons. During and after the monetary renegotiation, nobody fully knows which season will come next. It's important to understand that all of the major asset classes thrive in a certain environment. There is a season for everything, and it's crucial that you learn this. Let's split the future into 4 seasons. Season 1, Rising Growth. In this season, financial products like stocks, corporate bonds, commodities, and gold have historically performed very well. Season 2, Rising Inflation. In this season, commodities, gold, Bitcoin, and inflation-protected bonds known as TIPS have historically performed very well. Season 3, falling economic growth. In this season, treasury bonds and tips have historically performed very well. And finally, season 4, deflation. In this season, treasury bonds and stocks have historically performed very well. Nobody knows exactly what season the monetary renegotiation will produce. Many, including myself, will speculate on the most likely outcome, but speculation is not good enough for my retirement plan A. In times of monetary renegotiation and unpredictable black swan events, normal market correlations can be completely random. Sometimes the markets move together, sometimes they don't. We saw this in 2008 and 2020 when the beginnings of the crisis showed that everything crashed together, including gold and Bitcoin. When such expected correlations break down, most traditional portfolios, including your pension, blow up. There is obviously a bit more to building this portfolio, like only using low-cost products, asset allocations, dollar cost averaging, investing tax efficiently, and using portfolio rebalancing to enhance protections. But in video 4, I'll share with you how you can put all this into action over the next 7 weeks.
Okay, am I coming through now? I think I put myself on mute. Okay, awesome. So I hear you. It is virtually impossible once you're in Bitcoin and crypto to get excited about traditional markets. And I know that exact feeling because ever since I've been involved, it's been very, very hard for me to look at it. But you have to appreciate here that what we're constructing is an all seasons approach. The returns are all, over the last decade or so, the returns have been made in the Bitcoin and crypto space, but I want you to not be scared of prices. And part of what we do is understanding that approximately 80% of your results is psychology. 20% is strategy, and I'm going to go through all of the strategy. But what is the difference between those that implemented Retirement Plan B last year versus those that didn't? I gave the strategies, it's the psychology side. And so the psychology is what drives people into making lots of crazy mistakes, jumping up and down and, trying to call the bottoms, call the tops and all sorts of stuff. But it is the psychology that makes a difference. So strategically, I want you, no matter what happens in Bitcoin and crypto, because you may feel incredibly excited. And when everybody's incredibly excited, it's very easy to get caught up in that emotion. And bull markets are incredibly exciting, but the bear markets are the most exciting because the bear markets is when you get to accumulate, and we'll be going through more in the different strategies. But at the same time, most people need some kind of implementation because when they're watching the value of their retirement plan go down and down and down during a bear market, psychologically, people do stupid things. And that's the exact opposite of what I've been doing and I've trained myself to think in terms of. And the way to do that is make sure that no matter when you retire, you've got an approach that will mean that you end up with some assets, whatever the outcome is. So although in Masterclass 1, I went through all of the 7 reasons why people don't get into Bitcoin, whether it be quantum computing, whether it be supply shocks, whether it be government bans, and I gave you all the probabilities and likelihoods of all these things. And if you haven't watched that, you can return to that later before we go live with the next Masterclass. But the traditional portfolio is designed to protect from all of the scenarios that can drive you into making bad decisions. Now, I also hear you, but isn't the dollar the world's largest regulated Ponzi scheme? If you've watched any of my content, you know that's exactly what it is. But imagine what it's cost for those people that bet against the Fed and they were completely right. The Federal Reserve in this monetary renegotiation, no doubt about it, is willing to give up on the free market capitalistic ideals, and they already have. They've already decided that markets don't matter. So now the markets are a function of the Fed, and the Federal Reserve is willing to chuck everything at it. They literally were willing to scoop up over 100% of assets, if you remember in Masterclass 1. We'll do a bit of review on that as well, which is more assets than they picked up since they started in 1913. And so people don't care about markets anymore. They don't care about the fundamentals. The S&P 500 is the S&P 6 with the big tech companies that have still got a ginormous growth story based upon the trends and where technology are going in the years ahead. And so it is really easy to think that these black swan events are things that you need to adjust to, but the history just looks itself. Remember, I talked about people thinking that Bitcoin goes into bull and bear markets, and I said pull up a logarithmic chart and you'll know that it's approximately 12-year bull market, and no reason to think that the demand for money you can own, money you can spend, and money that has a fixed supply is going to change any of those things. So I implement a retirement plan A approach, and although it's, I'd rather, for want of a better name, retirement plan B is my plan A, but it's plan Bitcoin. Retirement plan A is about taking it where no matter what happens, you are unshakable and prepared for all different outcomes using traditional financial products. And what we do with the online wealth management program is we go through your age, your methodology, and apply some traditional financial planning principles so you can figure out how much you want to put to traditional markets, how much you want to put to retirement plan B, and some of the allocations that we'll be going through in this masterclass. So every ounce of people involved in Bitcoin and traditional markets will be thinking, but who needs gold when you got Bitcoin? And the market agrees with you. You can see all of the money that went from the gold ETF exchange traded fund into the Bitcoin futures ETF when that launched, and why the SEC and the regulators are still making sure that they hold off the Bitcoin-backed exchange traded funds for as long as they could. But gold fulfills a different use case, as we'll go through before we go through the 5 Bitcoin and investing strategies. So remember this whole concept of fiat thinking versus Bitcoin thinking that I covered. The retirement plan A is really a bet on the Federal Reserve continuing to renegotiate the monetary system using central bank digital currencies and putting itself at the center, because approximately still the dollar completely dominates. And everyone's going to be telling you, but look at foreign currencies, look at foreign stocks, and they'll keep betting against the Fed. The approach that I take in the retirement plan B approach is to have a percentage of the retirement that goes in line with the Fed removing free market capitalism and eventually adjusting to a central bank digital currency led utopian nightmare as we remove all of our privacies, rights, and freedoms as discussed. But I see that as inevitable, predictable, and guaranteed. So thank God we have retirement plan B and Bitcoin to compete, as it were. And so obviously you don't Bitcoin if you're gold thinking. And sorry, Peter Schiff, you get picked on a lot. But Schiff thinking is the person that tells you bet against the Fed and bet against Bitcoin and hold gold. Now, gold has its role as a wealth preserver, as we'll see in the next short clip. But it's not going to generate you wealth, and it hasn't generated wealth. It's been the wealth preserver for most people for 5,000 years. And during a monetary renegotiation will probably play a very important role if most of the demand hasn't gone over to Bitcoin. But I still think that there's a lot more growth to benefit from until that happens. And I still think that gold has its place in the portfolio and the approach before, but we don't expect it to generate the returns. So just before we go through strategy 1 of the retirement plan B, let's do a quick video on how to think about gold and the role that it plays within the retirement plan A and your portfolio.
Physical gold has traditionally been the conservative wealthy investor's hedge in such a scenario, and is something everybody should have as your wealth builds. It's a big part of my retirement plan A, but most gold is stored in vaults in Switzerland and Singapore, and under extreme circumstances like political currency wars, the vaults might lock the doors and planes might not even be able to take you to your gold, as was the case in the recent lockdown. In previous monetary renegotiations, countries like the United States confiscated everybody's gold and made gold ownership illegal. As it's physically controlled in a third-party custodian in someone else's control, and most gold is paper derivatives that can never be settled, there needs to be a further hedge from gold risks. That's where Retirement Plan B comes in for everybody.
Okay, so that's all I've got to say about the traditional markets and gold. And as we said, when we do give people all of their spreadsheets and plans, they can implement and decide what percentages are right based upon the tools we give them, time of life, where they are at, what their individual financial goals are once they've done their personal balance sheet and their cash flow statements, and done the modeling that we provide with all the spreadsheets and everything. Okay, so the retirement plan B, let's get to the exciting stuff now. And again, if you're involved in the crypto markets, you probably think that this is a pretty boring approach. However, boring is not what we're analyzing when we are building our crypto and Bitcoin-centered retirement plans. We're analyzing results, we're analyzing the longevity, and depending on when you fall to retirement, so personally, I'm 41, and I'm thinking about a 20-year approach here. Obviously, you can cut that right down. And when we gave the free video series last year, we would say give it a minimum of 3 to 5 years. But however, it did end up over tripling in just the first year. But it's about getting your realistic expectations, because the crypto markets have driven people into crazy gambling mentalities, simply because the incredible amount of returns that have been achieved there. So Bitcoin investing in terms of strategies, I want you, if you just do one thing, and if you take away one thing, and I tried to give that in each masterclass, if there is one thing you take away, here's the one thing that could completely transform the way you think about this. And that is each and every month, the biggest goal of retirement plan B, the main goal is that each and every month you have more Bitcoin than you had the previous month. And I say Bitcoin, I don't talk about dollar value of your retirement plan B, because I don't want you to be fiat thinking. If you're fiat thinking, when the markets go up, you're going to think about it in terms of what you can buy. And that's because you're combining making the cardinal sins. You're not doing the money management things that we covered in Masterclass 1, which is you are combining your spending money with your investment money. That drives you to thinking as the value goes up, what are the things you can buy, and fiat thinking. Of course, in order to do that, you need to have some of that fiat thinking, which is why we have a percentage that is not fully invested in Bitcoin, because we don't want you planning your finances based upon what the price of Bitcoin is doing in the short term. So Bitcoin thinkers are thinking about accumulating more Bitcoin. And the goal of retirement plan B, when we do the Bitcoin investing strategies, is to always have more Bitcoin each month than we did in the previous month. If you implement just that one thing, it can drive so much of the mistakes and behaviors where people take all their Bitcoin, put it in the next Bitcoin killer and altcoin killer, ending up blowing up and having, converting it back in a capitulation, and ended up having no Bitcoin. You can achieve that by either reinvesting each month or using some of the approaches and rebalancing and the different portfolio theory strategies that we use in the retirement plan B to ensure that each and every month you have more Bitcoin than the previous month. That is Bitcoin thinking. What is a great way of doing that? The price of Bitcoin crashing. So those that implement retirement plan B are ultra excited about Bitcoin price corrections. While everyone else is panicking, you're thinking about, here's my opportunity to have more Bitcoin. And by following the retirement plan B approach, I'm not at the mercy of, should I be buying now? Should I be selling now? I've put my mechanical plan in place. And the more you can take these emotional decisions out of it, the better you are, the more excited you will be about bear markets, and the more prepared and unshakable for everything that comes next. Now, remember, we have things like traditional portfolios. We have stabilization strategies as well, so that even when you see your dollar value of your retirement plan going down in some kind of correction, we have advanced strategies whereby combining all these 5 different strategies that take advantage of that. So with that said, let's go back to the video and look at those very important lessons about how to think when implementing strategy 1, Bitcoin investing.
The goal of my retirement plan B is to build a Bitcoin-focused portfolio that acts as a hedge and a higher risk enhancer to my retirement plan A and gold. It is designed to have an asymmetric reward potential that I expect to dwarf my retirement plan A by taking higher risks in good times, while at the same time is built upon a financial system that exists no matter what happens to the traditional financial markets. The assumption is that all the investment products still exist, even during the worst case scenario, such as the fall of the dollar and dollar-denominated assets, bank insolvencies, real estate crashes, government credit rating downgrades, hyperinflation of currencies, government debt defaults, or a breakdown of traditional financial markets and banks. I call it a retirement plan B, and I believe no matter what you think of Bitcoin, everybody needs a retirement plan B. It's built upon several assumptions. Firstly, that Bitcoin exists out of the traditional financial system and has reached a level of security that nothing else in the cryptocurrency market has achieved. Copies of all Bitcoin history and transactions are already stored on thousands of computers all around the world, and even satellites now, making it the largest, most backed up supercomputer in the world, fully independent of any major middle person, government, central bank, or any entity. Whether you believe in Bitcoin right now or not, I believe everybody needs to prepare for a scenario where the financial system systemically implodes, even if it never happens. We created a quick animation to bring you up to speed on Bitcoin in case you have been dismissing it up until today. So I'll play that for you right now.
Bitcoin is digital money, invented in 2009 as a secure way for people to transfer funds over the internet. It is often called the currency of the internet. Because it runs on a massive network of computers that cooperate with each other, there is no central authority in charge of Bitcoin, so nobody controls it, not banks, governments, or corporations. With traditional banking, sending money overseas is slow, expensive, and sometimes just plain impossible. On top of that, 2.5 billion people in the world can't use banks, open accounts, or get credit cards, and are essentially locked out of the global economy. Bitcoin smashes down this barrier and gives you the power to be your own bank without any monthly fees or anybody telling you how much you can use in a day. All you need is an internet connection to instantly pay anyone, anywhere around the world. As you can imagine, this gives cryptocurrencies like Bitcoin tremendous potential to change the world. In fact, many people around the world see it as digital gold for the people. But what gives Bitcoin its value? In the beginning, people traded things for food. They trusted that this many sheep was worth that many bananas. Then they traded things for metal coins. They trusted that this many coins was worth that many sheep. Then one day, someone created paper notes that were backed by gold, and people trusted that this many bills were worth that many coins. Today, the money that you see in your bank account is backed by credit, which is a fancy way of saying, we don't actually have this money right now. You just trust your bank when it tells you what your balance is. But if everybody went to the bank and tried to withdraw all their money right now, the entire system would collapse. There's also the problem of inflation. Governments and banks never stop printing money, which makes its value drop over time. Bitcoin eradicates these problems with a massive network of computers that keep track of where the money actually is, who has it, and who spends it. This network is called the blockchain. New Bitcoins are created every day, but at a very slow and carefully controlled rate. There will only ever be 21 million of them in existence, which helps them keep their value. Bitcoin uses powerful encryption and unique complex passwords to ensure that it never goes anywhere except to where you intend. If someone wanted to cheat the system and give themselves free Bitcoin, they would either have to hack millions of computers at the exact same time or build a massive computer network with an enormous price tag. It's incredibly unlikely that either of these scenarios could ever happen, making Bitcoin the most secure currency that humans have ever invented. But the value of Bitcoin fluctuates like crazy. Is it sustainable? The global financial crisis of 2008 is often considered the worst financial crisis since the Great Depression of the 1930s. During the crisis, the Zimbabwe dollar experienced a period of hyperinflation, and in July of 2008, this note for $100 trillion was worth less than 14 cents US. It was a powerful example of what can happen when a government tries to interfere with the value of its currency. Bitcoin was invented as a direct response to the 2008 financial crisis, where it became apparent that the world needed a currency that couldn't be tampered with. Today, you can buy a lot less for $1 than you could 20 years ago. This is because traditional currencies are vulnerable to inflation. When the value of a dollar drops, the government just prints more of them. New Bitcoins are also minted or mined every day. But this happens as a result of solving very complex mathematical problems that can't be cheated. And until the end of time, there will only ever be 21 million Bitcoins in existence. This means that Bitcoin will become more rare over time, instead of more common, like traditional currencies do. This will help keep the value of Bitcoin sustainable. So, if Bitcoin is so beneficial, so safe, and so sustainable, why are people afraid of it? Because Bitcoin exists in a purely digital world, its value can change a lot faster than traditional currencies. In December 2016, one Bitcoin was worth less than 1,000 US dollars. 1 year later, it rose to almost 20,000 US dollars. However, one thing you need to know is that Bitcoin should never be considered a get-rich-quick scheme. It's easy to lose money on Bitcoin if it's bought and sold at the wrong time. Over the long term, Bitcoin definitely has the potential to grow. In the short term, anything can happen. The one thing that makes Bitcoin super secure is also the thing that slows it down. Bitcoin runs on the blockchain, a network of computers that all have copies of the exact same ledger. Every time there's a transaction, the ledger gets bigger. When there are a lot of transactions, the whole network becomes congested trying to catch up. During these times of high traffic, if you want to send Bitcoin to someone, you need to pay a higher fee, or your Bitcoin could actually become stuck in the system. With that said, even a slow Bitcoin transfer is still faster than a traditional international money transfer. When it first came out, Bitcoin was widely adopted by underground marketplaces on the dark web because it was so secure and not many people knew about it. As a result, there's a public stigma against Bitcoin that only bad people use it. Drug dealers also conduct transactions using traditional cash, but that doesn't automatically make cash a bad thing. Nevertheless, it is common for banks to closely monitor accounts when they notice deposits coming from Bitcoin-related sources. It's also common for hackers to try and attack centralized websites that people use as Bitcoin wallets. Sadly, hacks are quite common, so it's important to store your Bitcoin away from centralized exchanges. There are 3 ways to get started with Bitcoin. You can buy it at an ATM, exchange it with someone you know, or use an exchange website. You don't have to buy one full Bitcoin. It can be purchased in fractions. There are over 2,000 ATMs around the world that allow you to deposit cash and get Bitcoin in return. There's a variety of mobile apps that can help you set up your own Bitcoin address and trade money with people you know. And there are lots of websites that will convert your money into Bitcoin. Just remember, these websites are centralized, which makes them vulnerable to hackers. Whenever you use exchanges or wallet services that are centralized, you lose the unique property of Bitcoin, which is personal ownership. With that in mind, it is definitely recommended that you store your Bitcoin on your own hardware wallet when you aren't using it to make transactions. It's also important to do some research and make sure that your bank isn't going to close your account when they notice deposits coming from Bitcoin exchange websites. Bitcoin is the world's most successful cryptocurrency. Are you excited to put the power of your money back into your own hands and want to buy Bitcoin? Sign up to BnkToTheFuture.com now.
So there you have it. It is for this reason that I will be using Bitcoin as the focus of my retirement plan B and taking measured risks with some of my Bitcoin in order to accumulate a larger Bitcoin position each month. The goal of the retirement plan B is to accumulate as much Bitcoin as possible and ride out any fluctuations it has against the dollar or gold. My retirement plan B will be split into 5 strategies that I'll share with you right now. Strategy number 1. Bitcoin investing. My retirement plan B invests a fixed sum each month into Bitcoin and diversifies by holding most of it in my possession using a strict security setup held in a tax efficient system with no third-party custodian or counterparty risk, and a structure that allows it to be passed on to my loved ones should anything happen to me. The important part about Bitcoin accumulation is to follow a fixed strategy so you never worry about price. This includes defined rules on exactly when to buy and exactly when to sell without having to look at charts every day and become a professional trader. I will automate the whole thing and remove all emotional connections to price and volatility by accumulating in crashes and rebalancing in bubbles automatically so I don't need to think about it.
Okay, so tattoo it on your forehead, print it on your desk, put it on your screensaver, remind yourself each and every month, do I have more Bitcoin this month, or do I have less Bitcoin, or do I have the same Bitcoin? And if you stick to this one principle of ensuring that you are accumulating more Bitcoin each month, then you're following the retirement plan B approach. And it drives you away from that fiat thinking because you're not focused on what is the dollar value of my retirement plan right now. It's how many Bitcoins do I have in the Bitcoin investing strategy approach. So if you take that one thing away, then hopefully this would be worth the whole masterclass, but I still got a lot more for you. And that's where people start thinking about things like tax strategies and various other things that could end up leaving them with less Bitcoin if they get these things wrong. Okay, so that's strategy 1. The next strategy is taking advantage of the opportunities of the wider crypto markets as a mechanism for increasing the fiat value, but also the potential Bitcoins within the retirement plan B by putting together, as we said, an automated approach. If the more of this you leave to making human decisions, the less likely you are to implement. And so the second part and the second strategy is crypto asset investing. And we're going to move over to the video now to understand the important layers of why we put this and why it is that the wealthy people in Bitcoin, and I know the wealthiest, they've always followed an approach of buying some Bitcoin, investing in the companies that build the infrastructure, and looking at the wider crypto market. So let's move over to strategy 2 of the retirement plan B portfolio.
Strategy 2, crypto asset investing. My retirement plan B will be investing a set amount each month into a diversified, high-risk, high-return portfolio of Bitcoin, crypto, and fintech stocks, consisting of both early-stage startups and more established crypto companies, and other high-risk, high-return opportunities like exchanges, mining companies, financial services providers, and others. Companies like crypto exchanges make abnormal profits during Bitcoin crashes and bubbles and normalize out my portfolio. They hedge against scenarios where alternative cryptocurrencies pump and dump. In crypto, there is always a new shiny object to lure you in, and I just let the exchanges make all the money from these pumps and dumps and accumulate value by owning their equity. Thanks to the company I co-founded and am the CEO of, BnkToTheFuture.com, this is now possible, and the wealthiest in crypto have combined owning Bitcoin with owning stock in Bitcoin and crypto companies to accumulate significant wealth over the last decade. This is the retirement plan B version of the classic pick and shovel play, where gold investors invest in the mining companies rather than gold itself.
Okay, so people were asking in the Q&A section, what crypto assets do you hold? And I'm not going to go through the individual assets. I'm going to go through the makeup of the retirement plan B and how I keep it simple and why I keep it simple like that. Now, if you want to have a percentage of your allocation for going further and further down the risk curve, then no problem. But it needs to be part of a completely risk managed, well thought out, so that you're not just jumping around like crazy with no strategy and no approach and no money management and asset allocation. So the big lesson that I said in Masterclass 3 is the psychology of how do I have more Bitcoin this month than I did last month. In Masterclass 2, one of the big takeaways was money management, asset allocation, and when we go through structuring in a bit, how to combine all these different things together that make the retirement plan B approach work. And so one of the questions was, Simon, do you just focus on Bitcoin? What about Ethereum? And so full disclosure, I did invest in the Ethereum token sale with some of my Bitcoin, and Ether is one of the big makeup parts of the retirement plan B. The reason for that is because you might want to get, all of your temptation is to believe the hype about the next Ethereum killer. But the reality is, just like Bitcoin was created at a time when nobody cared, and it was able to secure much of its decentralization properties in a time when no one, and since then no one's been able to replicate it without being connected to a guru, an individual that everyone looks to, that make it in most events a security by many regulators as it moves forward. Ethereum was also created at a time and place where it was sold when it was very unclear about the rules around securities. And the regulators came out eventually and said it's sufficiently decentralized where it may not be considered a security, and therefore was given the ability to get a network effect, and has driven that network effect to the point where it's pretty much integrated with some of the major use case that having digital hard sound money as a cornerstone, which is Bitcoin, with Ethereum paving the way for you to, and you'd expect, because of the higher risk involved in Ether, you'd expect a higher return. So when we released the video series last year, it was talking about, when we'll go through in a bit, how you'd expect Ether to outperform Bitcoin because you're taking disproportionately greater risks due to its complexity, its challenges with moving to the next phase, and the sheer volume of use cases. But why I'm interested in Ether is because my investment thesis and my philosophy is that there are several trends that are coming through, and Ethereum is just, far and away where most of the developers are thinking about in terms of doing this. First one, metaverse. So whatever generation you come from, I know because we're talking about retirement plan B, most Gen Z, most younger people won't be thinking along those words, retirement, but it's all about a metaphor for you thinking more long-term, because the internet is driving everybody into shorter and shorter term thinking. And the huge returns that have been driven in the crypto industry has really many people, many youngsters didn't invest. They didn't look at traditional assets. They didn't look at gold. They came straight into crypto, and they have these expectations around the returns that drive them into really, really gambling behavior. So you as a different generation, and I was brought up in a generation where when I went to school, we were using pen and paper. And then when I went to university or college, I was using computers. And then when I got involved in the financial markets, it was all algorithmic trading and high frequency trading. And then when I got involved in crypto, everything just accelerated at a scale we've never seen with the financial innovation that came from that. So having seen those different generations, I know that it's very easy to think things that you don't understand mean that you end up writing it off as something that's going to be happening in the future, an investment product. The metaverse, the writing is on the wall with people's everyday normal lives. Most young people now prefer their life in the metaverse, in their virtual life. When I wrote the book, Bank to the Future, Protect Your Future Before Governments Go Bust over a decade ago, it was the first published book in the world to include Bitcoin. And a section of it was covering things like Second Life and what we now call the metaverse and the different trends that people need to be adjusting to. So when we covered Second Life, I was also covering the different virtual assets and cryptocurrencies. Or there weren't many cryptocurrencies, but it was talking about the different like QQ coin and various other networks that were being built. Over a decade later, the writing is on the wall. Facebook has rebranded itself and decided to be Meta because the metaverse is clearly part of the trends. And a lot of that is all being built on top of Ethereum-based tokens, Ethereum-based governments, and the Ether ecosystem. So I expect big growth in these areas, but remember, it does come at a higher risk. Bitcoin is that digital hard sound money that doesn't make many changes. We had upgrades today. For those of you that were following me on Twitter, we had the upgrade with Taproot today, which is about taking many of the things that are currently being done on Ethereum and making it possible to do it on Bitcoin with greater privacy, greater scalability, and the ability to do a bit more scalability into smart contracts. However, Ether does have a significant effect there. During the Great Depression of the 2020s, when we went into lockdown and pandemic, we were bringing up the next wave of children that were in lockdown. Any babies that were born during that period, they have a stronger relationship with their phone and their screen than any of us ever had in the past. Many of us are now addicted to our phones, but these babies that were born during this time, they had relationships with their phones because they were speaking with their grandparents and various other things. And the relationship that these people have is really going to be driving people into this metaverse. The human contact and the psychological effects that come out of this pandemic, where many people are scared of human contact, they're not willing to hug each other anymore. They feel like it's a danger sign. They were given these psychological, triggers around the dangerousness of human contact, dehumanization. And all of these trends are going to be driving people where the next generation of baby boomers, as they built their inheritance and their retirement plans, their inheritance comes through to this next generation. This next generation that was brought up in the crypto realm, that was brought up in various other things, that may even prefer their virtual life to their normal life. They're going to be putting all of their retirement, all of their inheritance, and putting it into the asset classes and the tools and the mechanisms that they understand. So to rule out the metaverse just because it's not something for you or you don't understand it is really fighting the trend, because the next generation are going to be living their lives. And if you haven't watched Mark Zuckerberg's presentation on the metaverse, you'll understand where Facebook and Mark Zuckerberg and various other people think that it's going. Now, all the centralized companies are going to want to own that metaverse, but they're all discussing the interoperability. And if any public blockchain is used, it's highly likely that it's going to be the Ethereum blockchain that is used as this all develops. Now, obviously, there's a bunch of people that want to kill Ethereum and say they can do everything cheaper, better, or faster. But it's the same thing that would happen with Bitcoin. Everyone's saying they can do cheaper, faster, better. And then you have these gambling types of asset classes that are trying to take away some of those network effects. But in the metaverse, much of the base layer when it comes to blockchain is being built right now on top of Ethereum. What else do we have? Decentralized finance. Some people might mock it and say it's not decentralized because it doesn't have, because Ethereum has some of the more centralized properties and therefore it's not decentralized. But there is no doubt in my mind that this cat and mouse game with regulators, where regulators are driving people, the innovation in decentralized finance, and then the innovation is coming where they're adjusting to the regulations, making on-chain KYC, know your customer, on-chain securities laws compliance, security tokens, various other things. This decentralized finance is a constant game of cat and mouse, and every single financial product in the world, from my estimates and from the presentations that I've been giving over the years, is going to be put onto blockchains. And there is obviously still risk that regulatory, and they're going to try and put those into the regulatory oversight, but that leads to more innovation. And by the time the regulations are written, the new innovation comes along, and you're always going to see this side. Now, almost all of the decentralized financial products that are built up until now are built upon Ethereum. Now, many people will be talking about, and I've covered it, non-fungible tokens, and you know, all of these people trying to sell you gorillas. Every time I put out a tweet, I've got 15 people trying to sell me their non-fungible token. But the non-fungible token ecosystem is a lot more, from my estimations, than what you are seeing right now. When you talk about moving to the metaverse, you have decentralized financial products, you have digital hard sound money as the base layer. You then have on top of that much of the innovation that's happening on top of Ethereum, and the interoperability of those virtual assets and virtual goods that are coming from people engaging in the metaverse more and more and more. And so although we are at this stage and at the time of creating this masterclass, a non-fungible token bubble where people are just creating things, I have no doubt in my mind that as people move and migrate more to the metaverse, the ability to own your own assets and your own tokens that have unique properties and unique value is going to grow and grow and grow as a use case. And almost all of those non-fungible tokens and the different ecosystems that are being built upon the Ethereum ecosystem. So Metcalfe's law is in full effect here. And so how is an investor meant to take advantage of all these things? Well, that is exactly why the Retirement Plan B strategies were implemented, in taking all of this complexity, simplifying it down so that you are not driven into the types of behavior that makes you blow it all up and lose and end up with no Bitcoin, as I have seen from far too many people over the decades. Well, the way to do that is to invest in the stocks and shares of the exchanges. So many years ago, and when I first started building an investment thesis, I took the different areas within the Bitcoin sector and tried to get as many companies to list on BnkToTheFuture.com so that I can invest in some of their shares through private equity and diversify as wide as possible. And by investing in cryptocurrency exchanges in their stocks and shares, they have to adjust to all this stuff. They benefit from all of the crashes, all of the pumps, and they, we got the screen going. We'll move back over to the next video and fix the screen. But they benefit from all of the different trends because they have a full team of people and they have to move when the new thing comes along. They're listing it on there, and you benefit from all the trends, all of the different things, just by owning some of the crypto stock in cryptocurrency exchanges. It normalizes out the returns during corrections because they make a lot of money when the markets go down. And also much of the stuff that's being built on top of Ethereum, we put that into our Retirement Plan B and benefit fully from all of this stuff without all of the complexity, all of the complications And that's what we work through in the Retirement Plan B approach. So my screen is messing around. And also remember, the Retirement Plan A is based upon the Fed and the Federal Reserve, but the central bank digital currencies are also coming through as one of those trends. So while I go and fix the screen, Dave's going to put on Investing Strategy 3, and hopefully the screen will be back on by the time we're done.
Strategy 3, Bitcoin lending. My retirement plan B will be investing a set amount of my Bitcoin each month into Bitcoin collateralized lending to receive a Bitcoin denominated income. By lending your Bitcoin and reinvesting your returns each week, you can increase your Bitcoin position by becoming your own bank and benefiting from the interest that traders and speculators pay to you to borrow your Bitcoin. This is what I call the smart side of the trade, being the lender rather than the borrower. The loan is backed by a high degree of collateral, just like banks do when issuing mortgage loans backed by real estate assets. The period could be weekly, monthly, quarterly, or annual, and the strategy taps into the eighth wonder of the world, compounded interest. Compounded interest is Warren Buffett's secret recipe by earning interest on interest. But you should know, earning interest comes at a cost, and that is counterparty and credit risk. So it should be done only with a responsible, risk-managed proportion of your position, but the idea is to just set those percentages, automate it, and forget about it. As more interest is earned, take more risk off the table through portfolio rebalancing. Again, all automated to minimize the amount of work and emotional decision-making.
I think, and I hope that you can notice a theme here. Firstly, the screen's back, so we managed to recover the tech. I hope you can notice a theme here, that it's all about allocating and managing different risks. One of the mistakes that I often see when people jump into this sector is they subscribe to, for example, Bitcoin maximalism, and therefore they put everything in Bitcoin. That may work out brilliantly for you, but it doesn't take advantage of the way that you can accumulate a bit more Bitcoin by taking advantage of the wider crypto markets and some of the other trends. Now, then someone comes along and says, hey, did you know that you can earn like 4.5% on your Bitcoin by putting it into a crypto lending platform? And then so somebody goes and transfers all of their Bitcoin, puts it in a crypto lending platform, and then starts receiving amazing yield relative to what you can receive outside of the crypto markets. But they are completely exposed to that crypto lending platform. And then someone else comes along and they teaches them. So maybe Andreas, one of the experts that is one of the experts that covers the security module on the Retirement Plan B online wealth management program. He comes along and he puts on his t-shirt, not your keys, not your coins. So then someone comes along and says, right, I get it. I don't want to have any counterparty risk. I want to benefit from owning my own private key. And so they go out and they get a hardware wallet. They follow the wealth management program. They set up, they get all the different equipment that we go through. They set it all up. They set up their ultra secure setup. And then they don't get a compounding effect because they didn't take advantage of putting some of that into taking counterparty risky in order to generate a compounding effect. Remember what we talked about in Masterclass 2, the benefit of asset protection, asset allocation, which leads to a tax deferral, which makes a ginormous difference in the end result, and then implementing compounding effects over the long term that dwarf the amounts that you could be contributing without a compounding effect. And so the Bitcoin lending, I see far too many people putting all of their money into these Bitcoin lending providers in order to generate yield. But remember, Bitcoin that you own is different to Bitcoin lent out. And so you have to treat it as separate asset classes when planning your strategies and approaches. But so strategy 3 is generating a compounding effect so that we can ensure, remember the rule, remember the mantra, each month thou shalt have more Bitcoin than thou had in the previous month. And so Bitcoin lending is one of those ways of generating a compounding effect, but not doing it with all your Bitcoin, because we don't want to be in a position where if some of our Bitcoin gets blown up, we end up in a position with less Bitcoin as a result of taking excessive risks through crypto lending. And so remember, we talked about this. A quick recap of the second approach is asset allocation, asset protection, making sure that we are benefiting from tax deferral so that we don't end up losing it, having to take out every single year, and using legal tax deferral strategies, and also making sure that we're benefiting from that compounding effect. So initially, when you deposit your Bitcoin, you end up with a piddly amount of Satoshis, but at least you're in the mindset of Bitcoin thinking and accumulating more. In the first few years, you end up with literally where the amount of Bitcoin that you've received in interest is more than the original principal. And then eventually the amount that you receive as a result of this compounding effect completely dwarfs the amount. So what is Bitcoin lending? Well, it is taking the returns from those that are excessively trading and gambling in the crypto markets. Because people borrow Bitcoin in order to trade leverage, and they collateralize up some of their Bitcoin, and it's backed by collateral. So it's not like when you go to a bank and you borrow some money and they're analyzing your credit risk. Within an investment bank, they have the collateralized lending division, which is where, just like a mortgage, the bank says, I'll lend you to go purchase that real estate. In order to do that, you need to guarantee the real estate so that if the loan goes wrong, I can repossess the real estate and you essentially become the bank in the collateral model. People are willing to borrow Bitcoin, and they are willing to put up more than they borrow in collateral so that if the price corrects, the lending platform, if they're managing their risks well, can then sell some of that collateral, and therefore it is fully collateralized and over-collateralized lending, depending on the platform. But remember, this is a gray area, depending on their regulatory requirements. The model may not be fully understood, so we don't put all of our money into crypto lending, because those that have done that in the past, and with exchanges and various other things, you get on the wrong side of those trends, and you can end up blowing the whole compounding effect as a result of that. So we generate a compounding effect with a part of the strategy. And this is about being on the smart side of the trade. Rather than you going to these ginormous over-leveraged platforms and deciding that you're going to try and bet and end up potentially losing and having a margin call and a loan, instead, you're on the right side of the loan and you're taking advantage of the interest that received from those that want to do excessive speculation, and are the ones that are always the 90% that end up losing money at the 10% of insiders. And remember what we talked about in Masterclass 1, being an investor is the great equalizer. You don't need to be an insider. You don't need to be a market manipulator. And everybody has the opportunity to implement all of these 5 investing strategies using the Retirement Plan B methodology. So become the bank. Don't be the person on the wrong side of the loan. And now we move over to the other network effects and the other compounding effects that we're looking to take advantage of. And strategy number 4 is stablecoin lending. So over to the video, Dave.
Strategy number 4, stablecoin lending. My Retirement Plan B invests a set amount each month into US dollar and gold denominated stablecoins that pay a fixed annual premium rate, APR, assuming that it maintains its peg to the dollar and gold, while reinvesting my stablecoin returns each period I receive it. This protects my Retirement Plan B from Bitcoin to dollar and gold price volatility and allows me to increase my Bitcoin position each week in exchange for counterparty and credit risk. Not all stablecoins contain the same risk, and there is an innovation coming down the line that protects you from some of the risk of bank bail-ins. It's all about risk management followed by automation. The goal is to set this up only once, then rebalance automatically as returns are made or black swan events happen.
So remember the return on investment video that we discussed in video 1 that we'll be reviewing today as well? Well, the only place that you can take your dollars and earn real return in the inflation rates that we have today, and depending in your country, you know, the reported inflation rates for consumer price index is approximately 6.2% in the US. And therefore, the only way to be able to generate real returns, most of the traditional investors, they're going into bonds and losing money because they don't want to take bank counterparty risk. So they're lending it to the government instead. And in the stablecoin lending market, you can receive real returns above inflation, and it normalizes out some of the during those market corrections. So if you haven't fully transitioned to Bitcoin thinking yet, and I know that that's a slow, gradual transition or fast for some people, then the stablecoin lending part of the portfolio allows you to benefit from the superior yields and returns that you can get at the moment in the stablecoin lending market, normalizes out some of that. So if you were looking at a dollar value, and depending on when you need to cash out on your retirement plan, listen, one of the really important things that we do with the wealth management program is actually knowing when they need to cash out and knowing when they're going to spend with an actual plan of what happens if it supersedes those goals and how to really model that through. Because most people, they just decide to take some out on a whim because they haven't really planned and thought through this stuff. And so by putting the stablecoin lending, you get another compounding effect that you can implement into your retirement plan B. And it also normalizes out because our retirement plan B wealth management program graduates will be going through exactly when they're going to be pulling money out in order to meet the goals that they set themselves when we covered that when they set their own financial plan. So stablecoin lending is a part of the portfolio in order to achieve some of that and normalize out in case you need to pull out money at a certain time, and it may be the wrong time to pull it out of the Bitcoin based upon your goals and how you set it. So that's the fourth strategy. And now we move to the final fifth strategy, which is benefiting from the growth of metaverses and DeFi and non-fungible tokens and central bank digital currencies even that are being built on the most likely to be built on the Ethereum blockchain. And the fact that it is now in the process and has transitioned from proof of work, where it's based upon miners burning electricity, to proof of stake, it gives the opportunity to where basically you receive more ETH for owning ETH and locking them up and securing the network. Then it allows you to take advantage of a fifth compounding Metcalfe's law effect and benefit from all those trends as well as the other things by combining it with crypto assets. And that is strategy 5, Ether, staking, lending, DeFi as well. And so remember when we talked about these returns, so the video that we covered, we talked about, I'm going to move over here. We reviewed the different annual premium rates. And so adjusted for inflation, if you had money at a savings account, then your money's worth less. If you had money at a deposit account, you're worth less. If you had money lent to the government, you're worth less. If you had money, even in the money markets, invested in products, you had less. And if you had money in stable coins in real term, you were losing money. And therefore, it needed to be lent out in order to generate a real return adjusted for the inflation effects. So strategy number 5 is Ether, lending, and DeFi. And we're going to move over to that video. So Dave, play the final strategy.
Strategy 5, Ether, staking, and DeFi. My retirement plan B will invest a set amount each month into Ether and receive an Ether denominated return for staking and lending it out. Ether is much riskier than Bitcoin due to its complexity. It's the second largest cryptocurrency and does not try to compete with Bitcoin. It's optimized not for its sound money use case, but a protocol for building things on a public blockchain, such as decentralized financial products. The problem with Ether is its complexity. Complexity theory states that the more complicated a system is, the more exposed it is to unexpected events. This is why I treat Ether and decentralized financial products as a complementary way to increase my Bitcoin position by benefiting from an incredibly active developer community, all coding up new financial products that work even if the financial system implodes. Rather than speculating on each new innovation that can drive you insane trying to keep up, I keep it real simple. Almost all the innovation in decentralized finance products are being built on Ethereum. And the theory is that Ether will benefit from all the innovation, but in exchange for a higher risk. Retirement Plan B allocates a portion of the portfolio to Ether and then stakes and lends it to receive compounded returns, automated, and then rebalances it in case it outperforms or underperforms Bitcoin. So there you have it, a retirement plan B for the season that I believe Ray Dalio has not adequately prepared himself for, season 5, combined with all of the 4 seasons that he has prepared himself for very well. If you're new to Bitcoin, this is a lot to take in. And I know this may sound complicated, but in video 4, I'll share with you how you can do it with me in a step-by-step format with myself and my trusted advisors holding your hand through the whole process over a 7-week period. I'll also implement with you the 10 additional protections I set up so that I can avoid scams, legally plan my tax strategy, plan for unexpected events, inheritance plan, and only work with crypto-friendly banks so I can move in and out of my retirement plan B to bank deposits and retirement plan A assets whenever I want without the risk of having my bank account shut down. The secret is getting the asset allocation right, removing emotion through automation, and using sound risk balancing principles. So in video 4, I'll be sharing with you how you can join me live online when I build 2 retirement plan B portfolios using $1 million of my personal savings and another one using just an income. Again, you can do that with any amount of savings or any income. I'll tell you how to implement these strategies with the most important investment principles that make this all work tax efficiently and with a long-term banking solution friendly to my retirement plan B approach. I'll also cover how to bring all 3 videos together and share with you how a group of you can join me each week live for the next 7 weeks to build your complete retirement plan B on autopilot. I'm talking about setting it up once, then logging in once a year to ensure it's all going to plan and adjust accordingly so you can get on with life. I also want to give you all the tools, worksheets, and spreadsheets I use to plan how much is needed to build and protect your wealth during the Great Depression of 2020 and how to think beyond this crisis to retire wealthy with both the retirement A and B starting right now. I'll see you in the grand finale, video 4, so we can put all this together. Please leave a comment below as I'd love to get your feedback on what you think of the 5 retirement plan B strategies. And once done, share this link with your friends and loved ones, as I believe everybody needs a retirement plan B. Remember, in order to receive your free copy of my book, Bank to the Future, Protect Your Future Before Governments Go Bust, you will need to have gone through all 4 videos and complete the final video that comes in a couple of days, video 4. In video 4, we'll recap everything, bring this all together, and announce the experts and my advisors that will be part of the retirement plan B alongside myself. So for now, remember, no matter how bad it gets, you are alive in one of the most interesting times in financial history, and I want you to be on the right side of that change. Thank you.
Okay, so there you have the complete 5 strategies. Now, I know that there are going to be some people in the comments right now saying, well, I could beat the shit out of all that by investing in Cardano or Solana or Shiba Inu and, you know, all of these conservative returns, and they don't need any of that. None of that complication is necessary to achieve your financial goals. So when you've actually set your financial goals and you've gone through the spreadsheets and you put together exactly when you want to pull money out, when you don't want to pull money out, what the things you're looking to achieve are, you realize that going further and further down the risk curve is something you can do with a small percentage, but it's completely unnecessary by fully understanding these compounding effects, the results that can be achieved. And compounding within the crypto space has historically, obviously historical performance is no indicator of future returns, but has historically rewarded the saver in incredible ways in the crypto space. And so going down these excessive risks and risking all your Bitcoin is really just something that's completely irrational if you've done the exercise and you've done your homework and you've set everything up how you want to do. As I said, I want unshakability. I don't want you going through the emotions of all the amateurs, and hopefully that's something that everyone will be implementing as well. So a quick review. You're going to move over to questions shortly. So here's what we're going to do from here. We're going to take some of your questions. I believe that there's, if you've logged in, if you've joined us recently, in order to get your questions answered, we're not answering in the live chat on YouTube. You need to head over to retirementplanb.com, and it will take you straight to where you can watch this from within the website. And below it, there is a bunch of a section where you can just ask your questions, upvote other people's questions, and we'll be taking as many questions as we can. Tomorrow, we're going to have a large segment to answer as many questions that are left over. And we'll try, and I'm here to play full out for a week. If you're willing to join all these masterclasses, turn off all the distractions and play full out, we'll give you everything you need to be in a position to be able to put this into action from next week. Okay, so that's strategy 5, E for lending. So here's what happened. I taught this strategy 1 year ago. For those of you that put it into place, some of the asset classes adjusted for one of the highest inflation periods as a result of excessive money printing. And so we compared it. If you want to return to this and go through very comprehensive, I went through this very comprehensively in Masterclass 1. Return to the recording that will be all available for the rest of this week. And I compared what your position would have been if you put $1,000 in during the breakout of the pandemic and when we released the video series. And so by following this, your $1,000, if you had put it into Bitcoin, you'd now be worth $8,300. This is not even factoring in the compounding effects that can be achieved. If you put it into Ether, you'd have over $38,000 adjusted for inflation. And your stable coins would still be worth the same, but you'd have the compounding effects from them. And if you put it in the stock market, in real terms, you'd be, $1,400. Put it in gold, $1,100. And if you put it into stable coins, obviously you would have lost some due to inflation, but you would have had, if you had lent it out, then you would have got some real returns as a result of that. And so this is producing the exact returns that you would expect in line with when we originally produced the 4-part video series. And each of these asset classes completely fulfilled their goals. It did exactly what we said it would do to protect you from inflation, deflation, economic growth, and economic decline. So congratulations to people that put that into action. So what we're going to do now, the running order of events from here, is we're going to get an incredible story where Chris, one of our online wealth management program graduates from last year, he'll be sharing some of the key distinctions, because it's all very well for me to tell you, but some of you might be thinking, yeah, well, Simon, you've been studying finance for 20 years and been involved in all sorts of stuff. Is this really something that I can do? I may be newer to the industry. Well, Chris is going to share somebody that joined the industry more recently and some of the results that he achieved by just implementing, following the strategy and following the online wealth management process. And then we're going to move over to the questions, and we're going to answer as many questions before we move to the final segment of the day, which is where we're going to be covering some of the structuring so that you can benefit not only from those compounding effects, but some of the benefits of asset protection is the ability to defer your tax and pay as you go. So we'll do a quick recap on that, and then I'll share with you the exact structures that I put together in order to put all of this into my retirement plan. And again, we're also going to be moving over to the bonus segment. For those that are watching the live, if you're watching the recording, it will be edited out, where I get Adam Vaziri that will be sharing some of his ideas on the different portfolio builder structures that we put together so that investors can capitalize on in order to implement this all in an asset protected and tax deferred way. So we're going to move over to that video, which is Chris, where he's going to share some of the distinctions and learning that he got. And then we're going to head over to Slido. So feel free to go to retirementplanb.com, enter your email, and then you can read through some of the other people's questions, upvote other people's questions, or ask your own questions. And Azad's going to jump in and we're going to cover as many of those as we can. So let's move over to Chris now.
Hello, my name is Chris Cyber, and I work for the Department of Veterans Affairs as a pension claims adjuster. I started crypto in May of 2000, in May of 2020. I've been following the space beforehand, but kind of thought it was scammy with all the pumps and dumps and stuff like that. After the pandemic happened, I went into a pretty good research of how money was, the economy. I found Simon through that work. Luckily, I went to a crypto conference in June of 2020, put on by Real Vision. And I realized that, well, there are a lot of other fun cryptos out there, like Bitcoin is the main one, Ethereum's the main one, and to not veer too far down the risk curve, otherwise you're going to get burned. And so that's how I started out. I took part in a DeFi summer of 2000. I kind of took some money that I had and I just went out and had fun and tried to figure out what the space was about. And I realized doing that blockchain, Bitcoin, decentralized finance, all of that is very real. And it's a very important way to kind of protect yourself against the Fed and the other central banks just basically expanding their balance sheet at 13 to 15% a year, which means our money's deemed based by at least 13 to 15% a year. And there's not much that keeps up with that besides Bitcoin and the NASDAQ. That is kind of my crypto journey before retirement plan B. I had a good plan. I just needed to make sure it was a good plan. I was previously earning some interest, doing some staking, not trading Bitcoin because I don't want to lose my Bitcoin, just putting small bets on some coins and seeing if they worked out or not, and dollar cost averaging into Bitcoin. One of the big aha moments was kind of the possibilities of Bitcoin in the future and how fast that it actually compounds. It's kind of hard for someone who wasn't in crypto beforehand to see how fast Bitcoin compounds per year and not going down like a crazy altcoin route. So realized it's much better to stick with the top two. And if I wanted to get riskier, I would just take some of the Bitcoin I had and try and earn interest in a higher place. So that was one of the aha moments. All right, my second big aha moment was the bonus material with the author who wrote the Bitcoin Standard. And as he was explaining kind of some economic theories behind Bitcoin, and that was a lot of the stuff that I've been putting in hundreds and hundreds of hours into, that I really saw how Bitcoin could be a constant in economics, that would really be a game changer in economic theory. There isn't any other constants in economics. It's more behavioral economics. Economics actually is. And so if you can actually take something and have it be like a concrete value and go forward and move on it, that is pretty amazing. So I had a little bit of money in before retirement plan B. My strategy was kind of take how Simon divided his buckets. So buckets 1, 2, 3, and 4, and just start maneuvering stuff within the buckets. And so the cryptocurrency that I had previously, I put a lot of that into what would be known as bucket 1, the security bucket, have it like cold storage. And then I took portions of that and then made interest at Celsius, fund stablecoins and Bitcoin, and then a little bit more riskier interest in why earn vault products. I basically took about 30K and made it 500K is what I've done with some of the crypto I had beforehand, and then changing the altcoins that I had that weren't very great into more Bitcoin and stable coins to then pay my tax bill when that will come up, and just transfer those assets out and into different ones. I also I got my wife's rollover 401k. And since I'm not an accredited investor, I can only use the public markets to invest in the Bitcoin equities. And so I took her rollover 401k and made that into what would basically be the equity portion of it. Got a bunch of Bitcoin mining stock, high growth funds like ARK. And then I also did the Bitcoin, the crypto ETF, where they get 80% of their revenue from crypto, and that's Block, BLOK. Find it better than the other one because it actually has crypto companies on it and not just like a bunch of IBM type of players in it. And so that has been really helpful to basically see how he broke out his buckets, and then I did a version of that on my own. So I was doing fairly well before RPG, but Retirement Plan B really focused me in onto acquiring more Bitcoin, so that some of the altcoins that I made lots of percentages on, that I could then turn into Bitcoin and keep those gains. Simon kind of explained that, well, you can make a lot of money in the altcoin space. They do not hold their value during the bear markets. And so if you are lucky enough to strike it good in those areas, you should take those winnings and put them into Bitcoin to hold it. And that is what I have done. And I have kept most of my winnings. I feel very confident about my financial future. Right now, I am actually currently helping other people implement like a version of this, just trying to get them into Bitcoin and dollar cost average. And if they want to go down the alt route, hey, just take your 10% and go have fun, but put most of your money into Bitcoin. And that has been very successful for lots of my friends.
Okay, thank you. I hope that was useful to understand how people that take action put this into place, and some of the benefits that they've received as a result of that. So now let's move over to you, take a couple of your questions before we move into the final part of the content segment, where we'll be going through structuring and how to structure a crypto and Bitcoin specific retirement plan so that you can benefit from the examples that we discussed in the second masterclass, with the asset protection structures that allow you to defer your tax, because by deferral, you end up with a significantly different result than taxing pay as you go. And so using some of the legal structures, and we'll share some of the thoughts and how to think about that. So Azad, are you able to unmute yourself, and we can pick some of the top questions on the board?
Yep, can you hear me?
I can't hear you, Azad.
Hey,
right.
Hello.
Okay, that's not coming through on the earpiece for me.
Hey, can you hear me? Hello.
Just trying to sort out the tech so that we've got the earpiece going.
Hello.
Did you say something?
Hello, can you hear me?
Yeah, I can hear you now.
Okay, brilliant. Right, I think the first question we're going to do, so anyone who's on Twitter, feel free to tweet out to Simon Dixon. That's Simon Dixon Twit. That's TWITT. So we've got a question here on Twitter from Tony Jeffries. So Simon, loving your masterclass season. Looking forward to the third one. Would it be possible to explain the difference between retirement plan B and portfolio builder? I think what Jeffrey's referring to with the 500 is the fact that there's 500 spots only. So not too sure which one would be best for me and which one to apply for.
Okay, so I'll make this crystal clear. So some people are confused with the different offerings that we have. So the Retirement Plan B Masterclass is free for everyone to join, free to go take away, implement, put it into action. generate some returns, do what you need to do. The Retirement Plan B online wealth management program is what will be starting next Monday. And that's where we go through, it's a training portal. In session 4, we'll go through a bit more, and I'll cover a bit more on what the different structuring things as well today. But that's really about educating yourself and implementing everything step by step with my experts and myself. I'm the core person, and just going through all of this step by step so that you just finally get it all done. While there's an incredible amount of learning in there, but it's all logically done so that you can just hold your hand, work through the financial plan and do it all step by step. Now, once we completed and everyone having the education, there's a subset investors that we're able to offer a done-for-you service, which is where I can take my structure and it's called a Retirement Plan B portfolio builder. At the moment, it's only available to those that have a minimum of $1 million of assets for regulatory reasons. But next year, we're applying for a license to make it beyond just those that have $1 million of assets and are classified as a high net worth investor. But it's exclusive just for those on the online wealth management program at the moment as well. So for those that want to actually have the structure done for them and use the exact structure that I use that we'll cover in this as well, then we have a portfolio builder service that we launched with the Retirement Plan B online wealth management program. So one is about really putting together the plan, knowing exactly how to define your strategy mix and going through the whole process and sorting out everything that you need to sort out. And then the portfolio builder is just, you can go and do it. You don't have to do the portfolio builder. We teach people, but those that actually qualify for that and then want to use the exact same structures that I'm using, then we expanded the portfolio builder service to automate this whole process. But it's in beta at the moment, and it's just exclusive for those that are on the online wealth management program. Let's take some more questions from the Slido board.
How often do you make rebalances? Rebalancing the portfolio also generates capital gains tax. Do you assume the tax loss when rebalancing or receiving lending yield?
Yeah, so this leads to structuring as well. So if you own your Retirement Plan B as an individual, then you generate taxable events depending on your jurisdiction. Can't take this as tax advice, but in general, you generally create taxable events depending on which jurisdiction you're in. And therefore, owning it as an individual means that rebalancing leads to you having to take some of those off the table, which is why you have stable coins and various other things. If you, however, structure it within a tax deferral place, then if you chose to rebalance, then you won't necessarily be creating taxable events as you rebalance because you're doing it on a tax deferral basis within a structure that will make a bit of sense when we do the second segment. So it's a very important thing to consider. Once you've been through the process, you know your tax situation, you know what taxable events you have, and we cover all of that, then you can put together a rebalancing plan. For those who are not familiar with rebalancing, it's about having fixed percentages in each strategy. And once a year, for example, and I only, the type of rebalancing I would do is something like once a year, then you can, if, for example, Ether has gone to the sky's the limit and has produced a fiat value a lot higher, then you can convert some of those into Bitcoin and rebalance the portfolio back to your original percentages. It's exactly what professional fund managers do. It's what institutional investors do. And they define their percentages. And that's why it's so important to work through the investment goals, your financial plan, and then you can just unemotionally stick to those and rebalance once a year is more than enough from my perspective. There's different theories if you want to get more advanced into that. But just a simple, I like to keep things simple as much as I can. Okay, let's take 2 more questions, then we'll go into the content and take some more questions.
All right, next question is, can I move my current retirement account balance, US 401k IRA, into your portfolio builder tool?
So the idea here is that firstly, I can't give you that specific advice because it depends upon your provider, it depends where you are. But we put to the portfolio builder structure, which we'll cover as we go through structuring, is designed so that it is simply a share in a company. And so if your IRA, your retirement plan that you already have set up, allows you to purchase private shares in a company, then you can simply combine your IRA with the retirement plan B portfolio builder structure, provided that is compliant with the structure that you have set up. And so we'll cover that more in the next section when we go through structuring.
Okay, next question.
Okay, one more question. We'll cover the content and then we'll do more questions after.
What does the portfolio builder build-up tool automate? Can each investor using it still customize asset allocations to his personal preference, or it's like a fund?
No, it's not a fund. It's designed not to be a fund because that has very different consequences on that. So the portfolio builder was set up so that you define the strategy mix, you go through the program, you complete all of your goals and your exact allocations, your strategy mixes, and then if you qualify for the portfolio builder, then it automates that whole process. You send your funds in, and then it just simply allocates exactly according to your structure, your strategy mix, so yeah, it can be done exactly to that. It's designed so that you, it's not someone managing money for you, it's you managing your own money and taking advantage of all the structures in order to make this process significantly easier, because at the end of the day, complexity is the enemy of implementation here. If this becomes too complex, then people tail off, they don't stick to the plan, and if you don't stick to the plan, then you don't achieve the results that you set for yourself when pulling together your own financial plan. So I'm going to move over to the structuring content. We'll make sure we get content today, and then we'll move over to some more questions. And then approximately, I think about 12 minutes towards the end, we'll move over to the live viewer bonus section. And if you're watching a recording, that will be edited out. But join us tomorrow to make sure you get access to the live viewer bonus, which is a sneak peek inside some of the expert advisors sharing exactly how they structure these things and how they think about it. So we've got Adam Vaziri this time. In Masterclass 1, we had Andreas Antonopoulos on the security side. In Masterclass 2, we have Pamela Morgan on the inheritance side. And in this masterclass, the bonus content will be Adam Vaziri on the structuring side. So let's dive into a bit more on structuring and how to create a cryptocurrency retirement plan. So if you were there for Masterclass 2, sorry, the white screen sends me all dark, you'd be very familiar. Oh, there we go. The magic of the different camera angles. You'd be very familiar with the 5 steps that we went through for legal tax efficiency in 5 simple steps. The very first step was, let me see what we got here. I don't want to get in the way, is to immediately minimize your taxable events until you put together your plan and your strategy of how you're going to deal with it. Then it was to make sure you put together a record keeping strategy so you can understand where you're at, you can analyze the situation, and you can use much of the tools and softwares to make that a bit easier and a bit less painful. Then step 3 is to really fix your current situation, because you may not have done everything properly. You've got a bit of fixing to do. And then you put together a structure in order to do legal deferral so that you can benefit from the full compounding effects. And then finally, you can decide where you pay as you go. So when you pull money out, it creates taxable events, but you can defer that until you decide. You set your goals, you put together your plan, you know the likely tax liability at that stage, and you might even decide to implement a relocation strategy. I know that that's a lifestyle decision. Some people, it's totally right to just pay the right amount of tax and rather than relocate because their family, their lifestyle and everything is there. But you could decide to implement a relocation strategy and understand the various different things in putting together that myriad of complexity. So that was what we covered in Masterclass 2 and the approach. But the really important thing in structuring is this concept of ownership. So what is really ironic here is that Bitcoin gave people the ability to own their own money, one of the key value drivers of what makes Bitcoin what it is. However, what do the richest and wealthiest 1% of the world do? They try not to own anything because they implement structures where the assets are not held in their name. Now, that doesn't mean that you can't take advantage of some of the opportunities of the ownership, but who owns your Bitcoin is going to be one of the ultra important questions when thinking about structuring strategies. And remember, this isn't this is asset protection structures that also have side benefits of tax deferral, and therefore you can benefit from the full compounding effect without having to each year eat into the compounding effect. And so when you think about ownership, the first thing we do is we start walking through the different models. So most people, they just simply own everything and they would implement this as an individual, which is obviously the least efficient way of doing it. Because when you own it as an individual, depending on your jurisdiction and your individual situation, I have to keep reiterating, I can give you general things to talk about with your tax advisor, but I'm not a tax advisor and I don't know your situation to be able to give you the individual. Some people need to create taxable events as part of their tax approach and tax strategy. But in general, most people own these things as individual, and individually owning it is in general the worst structure with the least amount of opportunities for putting together asset protection structures. So then people start looking at owning it as a company. Now, a company structure does have many benefits depending on your situation, jurisdiction, type of company that you use. But it's one of the things, the main things that we use when structuring the retirement plan B, so that you can, rather than having to get into all of this complexity, there's decades and decades of experience of how to deal with shares in terms of taxable events and tax situations, asset protection, legal. But with all of the cryptocurrency stuff, it's all being reinvented, reimagined, people treat it all differently. And every single type of transaction you do in DeFi, whether you get staking, whether you receive interest return, whatever it is you do, whether you do leverage in a futures contract, they all are treated slightly differently and open to different interpretations. But by using a company structure, you get to just benefit from the absolute clarity and treatment of a company. So shares are a very good way of simplifying the process, implementing asset protection, and if you structure it right, achieving the correct level of deferral that you need in order to benefit from the full compounding effect. The other one is owning it through an official government-supported retirement plan structure. So in the questions, you heard about people talk about IRAs. If you're in the US, you have an IRA as a structure where you have self-investment, and you can, depending on which IRA you're using, you're able to defer those taxes, and the government wants you to, because this is encouraging investing. They're trying to encourage it through these structures. In various other countries, you have self-invested personal pensions and various other things, but this is where you get to direct the flow. Now, each structure in each IRA will not necessarily be able to implement all of the 5 strategies, which is where putting a portfolio builder underneath a retirement plan structure would, in most cases, qualify depending on your jurisdiction. And that was the question that was asked. And depending on the structure and depending on your supplier. So using your existing retirement plan structure and putting together something underneath that qualifies, that can implement and automate the whole retirement plan B5 investing strategies is another one. Another thing that's common is some people might have family trusts, they might have living trusts, they might have various different structures, and some of you might be very, very advanced, as Adam Vaziri will go through when we go through the live viewer bonus content. But putting a trust structure, which means that you don't own it, you may have a beneficial interest or a benefit from it through your family trust structure, becomes a completely different way of owning that. So one of the things to consider is who owns your retirement plan B. And that's an important factor to think about. And then what structures can you put in place to still benefit from the full compounding effect and achieve the financial plan that you put together for yourself. And those are the different types of structures we're thinking about. So if you would like a breakdown of the exact structure that I hold my retirement plan B is also used within the portfolio builder for those that qualify, but also just to give you the fact that we spent hundreds of thousands. We got KPMG tax advice, we got different compliance advice, different structuring advice, and we were doing it live with the retirement plan B group 1, the last 500 people. But here's the end structure that I came up with when I invested the personal savings that I discussed in the other videos, and the same structure that is used with the portfolio builder. So the structure is that I use is as follows. I personally have my retirement plan B structured into a Cayman Island, what's known as a segregated portfolio company. I'm not going to go too deep into the legal consequences of that, but I have that as the owner of the retirement plan B, and then I am the shareholder in that. In order to have those assets benefit from some of the compounding effects, I have a custodian that is a regulated Hong Kong trust, and we segregate the assets so that they are fully owned under that structure. And the reason for that is because in Hong Kong, it's one of the only countries around that only considers assets in Hong Kong and doesn't consider assets outside of Hong Kong the worldwide wealth. So when you combine the Cayman Island company structure with a Hong Kong custodian and a trust structure, then you can implement much of these different strategies. And so when it comes to stored, it's all offline, and it's used using Ledger Vault, which implements a layer of insurance into that structure as well with the custodian. And so I'm using Ledger Vault in order to take advantage of some of those compounding effects in the retirement plan B. And I get the mix between custody and self-custody, because if the custodian, something goes wrong there, then I have my self-custody. If something goes wrong with the self-custody, I lose the private keys. If you're following the security settings with Andreas, then you minimize the likelihood of that happening, but you don't blow everything up by losing your private key and by getting the mix right and risk managing the different effects. The lending effects and the lending is for the portfolio builder. It's done in partnership with Celsius, full disclosure. I am a two disclosures I forgot to make. The first is that the custodian that we use is in Hong Kong First Digital Trust. I am also a shareholder in that company, just so you're aware of the conflicts. And I am also a shareholder in Celsius. You don't need to use all of these providers. Feel free to discount these recommendations as pitching self-interest. I'll just give you the disclosures and I share with you what I'm doing, and then you can make your decisions as well in order to benefit from some of the interest and compounding effects there. That was deeply integrated. All of these services were deeply integrated into the portfolio builder. But as I said, that's only a subset of people that qualify for that. We go through exactly how to do this on your own as well. And finally, staking, deep integration into the portfolio builder with Fireblocks as well. For those that are just not ready to go through the technical complexity of staking Ethereum at the moment. and having those minimum sides. And it's still very early, so we haven't implemented this into that because we're trying to get a bit more progress with Ether staking in terms of where it is right now in its full implementation. With stocks and shares, then full disclosure here, I'm the CEO and co-founder of BnkToTheFuture.com, one of the largest shareholders in the company. So I will benefit if you end up qualifying and using that. But the stocks and shares are all held into a structure through Bank to the Future Capital. And that allows me to automate the whole process where I just contribute an amount each month. Then the allocations are all set based upon the plan. And then the withdrawal strategy is based upon the goals that I set for that retirement plan B. So when you plug all these different services together, then you end up with a really, really powerful structure. And then you can take that to your financial advisor, your tax advisor, your legal advisor, and determine the optimum given your goals. And, we at the Online Wealth Management Program give you all of the tools to be able to make those decisions on yourself, but also benefit from being able to give that information to the different advisors that you will, and hopefully get yourself in a position where if you're not ready to take on advisors at this stage, hopefully the compounding effects you can factor in, being able to afford those advisors in the future. But in the meantime, we give you all the tools on the Online Wealth Management Program to be able to implement that, combine all this stuff together, and put it together. And we've spent the big bucks so that you don't need to. And that's the exact structure that I use for my retirement plan B. In terms of substance, this becomes very important. So if you set up your own company and you're a director of your own company, then you have to have this thing called substance, which means that where your mind and management are becomes the jurisdiction. So if you do this from America, you need to consider substance, and the portfolio builder structure is set up so that the substance is with Cayman Island and Isle of Man, and taken of the benefits of all these different jurisdictions to make sure that you structure it in a way. And these are all the different things that you would need to consider in putting together a structure to benefit from all of that. And so that is pretty much the most of the content that we want to do, other than the live viewer bonus. But remember, the review that we did from the second masterclass is that we're trying to combine together all of these 4 different things into an automated structure so that we can benefit from achieving the financial plan that we put together for ourselves, so that we can benefit from all these compounding, automation, plug and play, so that you don't have to do all of the myriad of complexities that all the people blowing up their portfolios are doing. And even if you had that big winner, remember what Chris's story was, he had those big winners and then started putting it into things that they can, that has lower risk in terms of preserving and building those longer term compounding effects. And that is getting the asset allocations right. So spending some time investing, thinking about that, putting together the structures for asset protection that has a side benefit when you get the asset protection structures right, or being able to defer the taxes, being able to benefit from the compounding effect, and then pay as you go, decide whether you want to relocate or not. And that's the exact process that we go through throughout the wealth management program to put that together. And I want to make sure that you've got enough information to understand and appreciate the next steps for you, so that you can understand exactly what we went through and what I did live throughout the last video series. And in video 1, we covered the exact results that have been achieved by following the strategy step by step. So we've got 2 more parts for you until we wrap this up. The first part is we're going to take as many questions. And when it becomes approximately 12 minutes to 8, then Dave will let me know. And for those of you that are still tuning in with the live viewer bonus, Adam Vaziri will dig a bit deeper into how to determine who should own your retirement plan B and some of the considerations in putting together the structure from a qualified lawyer that's been involved in crypto from the very, very early days in 2013. Okay. And so, yeah, that's what we're going to be covering more in live Masterclass 4, trying to put all this together, reviewing the final video. And when we come in for the live Masterclass tomorrow, as we said, you'll have full details on a first come, first served basis for the 500 people that would like to join us next week on the online wealth management program. And we'll give all those details and links for those that attend the live tomorrow, and cover a lot more questions as well. So, as I said, we'll be sharing 12 minutes to the end of this. We're doing exactly 3 hours on the hour. This is a section from the wealth management program where Adam Vaziri goes through who should own your retirement plan B. So, Azad, how are we doing for time? How much longer have we got until 12 minutes to 8?
We got approximately,
I'm gonna grab some water.
We got 40 minutes. Roughly.
Okay, so we've got 40 minutes to take as many questions from the board as we can.
All right, the first question is, how much will the online wealth management cost? We got a number of the same question here, so I thought, let's get this one up.
Okay, so no inflation at Bank to the Future. We are releasing it for the exact same price that we released it last year. And so it's $2,997 for the complete program. That will be, because we're doing it for 500 people, that's the price that we need to charge in order to deliver the level of service that we need and keep it to a reasonable number given all the demand, and us be able to deliver that. So I'll be doing bespoke Q&A sessions at the end of each module. So the price is $2,997 and no inflation at Bank to the Future, the exact same price that we released it for this time last year.
Okay, are the investment opportunities in private equity that Bank to the Future offers, are they going to be part of the retirement plan B?
So I have an account for my retirement plan B structure on BnkToTheFuture.com. And with my account on BnkToTheFuture.com, for those of you not familiar, as I said, I'm the CEO and co-founder and a significant shareholder in that company. We created it to give people and qualifying investors a way of investing in the future of finance through stocks and shares in companies. Companies that our investors have invested in, early days, Kraken, Bitfinex, Bitstamp, Celsius, many other companies, Robinhood, Circle, Ripple Labs, Blockchain.com, your retirement plan B structure. So the 10 people that we baited the portfolio builder, and the first one was me, and then we brought in another 10 people. They have an account on BnkToTheFuture.com for their structure and their retirement plan B, and then they can use that should they qualify in order to invest in shares on BnkToTheFuture.com.
Does your structure deploy crypto on Celsius network to achieve compounding growth of crypto assets?
Yes, so my portfolio builder uses Celsius as the lending provider. And we do that with the three compounding effects that we discussed throughout this masterclass. The first one is Bitcoin, the second one is Ether, and the third is US dollar stablecoins.
Okay, our wealth management program and the portfolio build-up tool free for those approved to join in, or there's a management fee? If there is, what is it?
So the way we structured the online wealth management program is we're doing it once a year, 500 people, and the fee to complete that program is $2,997. The portfolio builder there is a setup fee. Those who have completed the portfolio builder, it's not a management fee because it's not a fund per se. It's a tool and a mechanism and a structure for you to manage and automate your whole portfolio builder. If you qualify for that, and at the moment, we're still working through the demand from the first round of people, and we're trying to satisfy that before the second round of people. But there would be a setup fee, a low-cost structure, and it costs approximately it's $2,000 to set up. But those on the wealth management program, they get a 50% discount on that. And then there would be a monthly fee. And so that would not be based upon assets under management. It's just a monthly fee of $49.99 to keep the structure in place. And depending on how long you hold for, we encourage longer term holding. Then there's the exit fee when you pull out there, which is approximately 1% or so. So we designed it to be a low cost structure. None of this 2 and 22% every year and 20% upon returns that the traditional venture capital industry follows. So we tried to structure it in the best way that doesn't interfere in some of the compounding effects that you do. And that's the same structure that I use.
Okay, question from Eugene. Is this usable by non-US clients?
Certainly. So in fact, it's more usable by non-US clients. So I am a non-US client of the online wealth management program and the portfolio builder. And there is more restrictions within the US because certain lending platforms are having challenges in the US to define it. But here's the great thing. The way we structure this is always doing things in compliance with securities laws. So if the regulators are deciding that crypto lending is a security, which is something that they are trying to fight for at the moment, then we've already constructed this to comply with that. And so it is already factored that in terms of the longevity. But absolutely, we've got clients from the US and clients from outside the US. And in Masterclass 4, we'll make sure we go through everything you need to know to make that decision about whether this is right for you or whether you want to continue on this path and perhaps join us next year or continue doing what you're doing.
Okay, question from Conrad. Hi, my partner and I are both interested. If one of us does it, would it be enough to apply the process to the other?
So when somebody joins the online wealth management program, you get one login details, and those are for your use only. Obviously, if you have a partner and you're going to be implementing this together, then no problem. But the important thing is that it's your login, it's for you. And if you manage your affairs with your wife or your trust or your structure, then no problem. That's that.
Okay, I'm 57 and retired, income from traditional investments only, hence more interested in wealth retention. I presume your system will also work for me?
So building and protecting your wealth is the thing. I discourage you from changing anything that you are existing doing that you've set up. These will all be your decisions. Continue doing what you're doing. This is a supplement on top, and get yourself comfortable with the supplement on top. My recommendation is to give a minimum of 3 to 5 years for this impact to be had. But as we said, those that implemented it last year already had a tripling of the value of their retirement plan based upon 1 year. Now, I'm not saying that that's normal, that's going to happen. I can't give you financial advice. I can't give you investment advice. You really have to work through that with your own, your own understanding. What we'll do is we'll give you the tools to be able to make those decisions, work through them with your advisors. We take advantage of both income, capital appreciation, and also protection structures. So we called it build and protect your wealth because we give the building and we give the protection.
Okay, question from Sue. Which stable coins are safest and how do you compare algorithmically calculate stable coins versus fiat-backed ones?
So firstly, there are stable coins that are backed by fiat currencies. There are stable coins that are backed by without being backed by fiat currencies. And they use algorithms. A few examples and full disclosure, I'm a shareholder in Coinbase and Circle. And Circle was the entity responsible for managing the USDC stablecoin, which is the second largest stablecoin. I'm also a shareholder in Bitfinex, and Bitfinex are the same management team that operate Tether, and Tether were the creators of the whole stablecoin concept with Tether. And I use some algorithmic stablecoins like DAI that are designed to algorithmically not be backed by dollars, but have mechanisms for maintaining their pegs. There are also innovations coming down the line, as we mentioned, where it's backed by trust structures, and those trust structures then diversify the deposit insurance liabilities by going across lots of different deposit insured banks. And therefore, they don't go into the bail-in structure. So deposit insurance, although if there's a systemic risk event, deposit insurance won't cover it. But if deposit insurance does cover it, then they make sure they spread those out using trust structures and various other things. One of the things we do is Adam Vaziri, the person that's going to be giving you the live viewer bonus, he actually goes through all the legal structures of all the different stable coins so that you can understand the different risks to manage in making those decisions about which stable coins to use. And again, it's all about risk management. They all come with different pros and cons and different risks. We got a whole bonus module where we go through the legal structure of the different major stable coins and how to manage some of those risks and understand it.
Okay, I am a scared one. Can you explain a bit more what type of coaching looks like? Is it a work through documentation? How does it work? Via Zoom, phone, mail?
Yeah, so we'll do that in the next video, but you can get a look inside, and maybe we'll do that next week. But essentially, we've created an online membership portal, and each week we release a new module. And in that module, we go through all the different videos, and you achieve the goal, and then you go through the implementation. We then give you the spreadsheets, you then do your homework. And if you're stuck on anything, then each week we do a call on Zoom through a Zoom webinar. And that's where you get to go through just like a session like this, where we touch on the questions just for that 1 week. And then we move to the next subject. You've got all the outcomes. You started implementing, then we do the next thing, and we go through that for 7 weeks. Then when it comes to implementing very specific things like your security setup, your inheritance plan, then you return to those bonus modules where we have experts in each field, and you have access to the membership portal for 2 years. And then you can return into those, and we'll cover more on that when we go through exactly how we put this together in Masterclass 4.
How do you compound your Bitcoin and Ether? Who gives that option?
So the Bitcoin and Ether, in my portfolio builder, I use Celsius. There's different buckets that I have. So you have the portfolio builder that has various custody solutions. And then you have the ones where you own the private keys that's taken advantage more of DeFi solutions that can allow you to do that. And in Bitcoin, we're getting more and more of those solutions. I've invested in different protocols that are enabling that as it moves forward. But the most people will be using within their retirement plan be a company like Celsius or other crypto lending platform. Within it, we go through in the income module, we go through the different pros and cons of different providers so that you can understand the different risks and how to analyze that.
Okay, Grebulon asks, looks like we're in the mania phase of the stock market cycle, normally followed by a crash. Do you think Bitcoin will play out like the stock market?
So when I think about Bitcoin, firstly, Bitcoin is a risk-on asset. So a lot of institutions are buying in Bitcoin as an inflation hedge. When you immediately have these shock events, you tend to have a correlation between Bitcoin and traditional markets like stocks. They're both risk on and things that people invest in to try and beat inflation. But what is Bitcoin long-term fundamental? So all of that is short-term. And the goal of Retirement Plan B is for you to forget about the short-term and focus on the time horizon that you put together in your financial plan. And so with the risk-on assets, they tend to correct together, and then the long-term fundamentals eventually kick in. So what is Bitcoin? Bitcoin is correlated to the demand for people wanting to own their own money, which tends to be driven by fear of bank bail-ins, those types of stuff. People needing to spend their own money, which tends to be driven by too much excessive bad regulations that interfere in the user experience of being able to transport money. And the third thing, excessive money printing that leads to inflation. And so therefore, Bitcoin is a hedge, it's a fixed money supply, and what's known as deflationary because it increases your purchasing power over time historically because of its fixed supply. So long-term, the fundamentals of people needing to own their own money, spend their own money, and having a hedge against excessive money printing kick in. And so eventually, over the long term, it is correlated to the demand and supply for those three use cases. Short term is a tool for speculation, is a tool for fiat thinkers to get rich quick, and then they dump very quickly when they see that their fiat value is going down. And so therefore, they tend to be correlated with other risk-on assets. This is why longer-term timeframes is the equalizer versus those focusing on the short term, which is driven by manipulation and short-term craziness as the world moves away from free markets driven by the Fed and excessive money printing taking the other side of all market trades.
Okay, next question is from John. How do you factor fees into crypto investing? They should be negligible, but are unpredictable and can be huge. So must be a risk to performance.
Yeah, absolutely. So minimizing fees is very, very important, which is why we don't overtrade, which is why we minimize taxable events, and is why we use optimum structures. So fees are very important on a long-term compounding effect. And so those are very important considerations in determining the longer term results. Now, yes, they can be very high if you're trading in and out, if you're doing all the things that the amateurs do. But the Retirement Plan B structure is really designed by default to minimize the taxable and feeable events by putting together asset protection structures on that. And yeah, fees is a very important thing to consider.
Okay, what is the difference between lending and staking?
So lending is where you take generally, so somebody borrows your cryptocurrency, they put up a bunch of collateral, and in exchange they take those. And if the price of their collateral goes down beyond the amount that they borrowed, then they have a margin call so that it can cover the loan. And lending is literally what it is. It's you're putting together lenders either through some kind of smart contract or through a centralized platform that facilitates as a broker. The staking is where you lock up your tokens, say Ether, for example, and you perform, when you lock them up, it's a bit more technical process. You perform the role of miners performing in Bitcoin. So when people go out and mine Bitcoin, they generate electricity, they purchase machines, they spend electricity, and they perform the function of validating all the transactions. In a proof of stake network like Ethereum, by staking, you are actually performing the function of validating those transactions. And the more of that token or Ether that you have, the larger the stake that you receive. And you receive returns for simply locking them up and proving that you are performing that function through staking. So it's another way of generating yield. It's a lot more unpredictable. but that's the difference between staking and lending.
Okay, not to get political, but do you have any worries about the Hong Kong assets ever being seized by the Chinese authoritarian government?
So what we do is we put a structure on top of that where the assets are owned by the Cayman Island entity, and they're not actually held within Hong Kong, they're held on a ledger vault. It is just taken advantage of the very beneficial trust structures that Hong Kong has in terms of analyzing global wealth. So we take out the worst of Hong Kong and put in the best of Hong Kong when we're thinking about that. So I'm personally comfortable with that structure when I'm using the right parts of it rather than the wrong parts of it. And so that is a risk of using any custodian. But also we put together, we can put those structure, hedge some of those risks, and we put that into the considerations as well. But no, I'm comfortable with that based upon the structure that is put together.
Okay, question from Sue. What percent of Bitcoin should you have in your cold wallet? What percent should you hold in exchanges? And what is reasonable number of exchanges to use?
Yeah, so the first thing is you should only ever hold Bitcoin in an exchange if you're going to be a trader. And the whole point of Retirement Plan B is to not be a trader. So in that way, you should not have any Bitcoin at exchanges. Now, whether you have some on custody, because custody is very different from an exchange, a custodian has a fiduciary duty to implement many of the practices that exchanges don't have fiduciary duties to implement because they need to make them available for fulfilling for traders. And so exchange is certainly not a place to leave it's either a custodian or self-custody is the different methodologies we use, or you're investing them through a lending provider in order to get some kind of compounding effect. In terms of setting the percentages, this goes through doing the financial plan. We have a process that remember Chris talked about, the bucket allocations. Once you've done your financial plan, you decide how much you're going to be from compounding, how much you need to meet your security goals, and how much are you going to be using to pull out money as you want to draw money out in order to buy the things that make life worth living for. And so really that depends on putting together that. And then you start with that. And then we give you a number of methodologies to determine what percentage based upon the goals that you set for yourself. So I know it's a bit of a cop-out because there is no one single answer. And that's why I can't just give you this individual financial advice. You've got to put the time in to go through that work of putting together your own plan. Then set the percentages, then stick to the plan. Then go through asset protection structures so that you have a long-term plan, set it all up, done for you, then carry on.
I live in New York, effectively blocked from Binance, Kraken, Celsius, Voyager, etc. Will this prevent me from successfully implementing your strategies?
Yeah, so if you are from the US and your state, like New York, doesn't allow you to use those service providers, then there's no way around that. You can't use those service providers if it's not legal for you. If you're using an asset protection structure, then it may be legal for you, depending on if you set up the correct structures. And so when we go through the wealth management program, there may be certain services, and that is one of the things that you can't use based upon the regulations. And this is one of the challenges with engaging in a fast-growing sector. But wherever that happens, we recommend, we put in different types of recommendations. And this is where the community comes in. And so all of the 500 people, we have an alumni group. They're all using different services. They're using IRA providers. They've been supporting each other. They've been putting together different things. We got tax opinions. We got in the US. We spent the money on doing that. And we got legal opinions. We got compliance opinions. And this is where community really comes in, because you've got a lifetime community of those that have all been through the same process. And so when the second group of 500 come through, they'll be able to benefit from the benefits and experience of the last 500 people that came through. And each year we'll be adding new and new members to the community. Our industry is a constantly evolving, constantly changing sector, but we've come up with some constants and made sure that the main challenge that you get in the US is around securities laws. So when we implement things, we do it in compliance with securities laws, so that you have some longevity in these structures, as opposed to things that are going to be regulated out of existence in the future. It is a challenge. I'm not gonna lie there, but we have clients that are able to use certain services and workarounds. But yeah, if you can't use some of those services, then you may need to use services that are available to you, or structures that mean that it's not you that owns it, it's something else.
Okay, we just got under 9 minutes, and then we'll move over to the bonus segment. Okay, next question. Would you pull out of crypto now if you were on the receiving end of a restructuring, if emergency funds are not enough to weather the storm?
So this is a great question. The way that I set up my retirement plan B is I have a certain amount that's allocated just purely security and emergencies. I make sure that I am in a position where that is enough that I don't need to deviate from the plan. I also have a set plan of the amount that comes out to achieve certain fixed fund goals and dream goals that I've set for myself. And there is a certain bucket where I never pull it out no matter what. And so this is all about coming through a bit of money management process. And then we've got different buckets as well. So my goal of the retirement plan B is to never be in that situation. And that's exactly why we separate our spending money, put together plans. And you may have a disaster in life that makes you deviate from your plan. That's just the reality of the world. But the longer you cannot deviate from your plan, the lower the impact that's going to be, so that you can benefit from the full compounding effects. So firstly, we make sure that we structure it where we know what we're likely to need. And then if it turns out that disaster events happen, we try and long out that as long as you can, but disaster is disaster. And we try and protect for as many scenarios as we can. So the answer is, I will set it up so that under as many circumstances as I can, I don't need to do that, and can prolong it for as long as I can, but also factor in that disasters happen and have the funds available, and the strategy available for being able to pull it out, and make sure that that's factored into the plan.
Okay, a question from Richard. Equally weighted crypto index of the top 10 coins outperforms Bitcoin and less risky than random alts. Is this a sensible long-term investment strategy?
Yeah, so part of the crypto asset strategy is that you might decide to hold an index of the top 10, and as if it rebalances and adjusts itself as the top 10 constantly changes, then that might be a perfectly valid product for you to generate some of those additional returns by taking a bit more risk as well. And now, again, there's risk. So there's risk of having diversification whereby whatever happens in the top 10, it's okay. But there's also the risk of Bitcoin being, digital hard sound money and nothing else competing with that. So we're managing these different risks, but I would put that into the strategy crypto asset side. And the products that are available to people to do such strategies are getting more and more sophisticated as the industry grows. As you said, Chris, when he was sharing his story, he adjusted to what was available for him because he couldn't access some certain products because he's not accredited. And so therefore had to look at different products that were available to non-accredited. And so certainly if you've put together your plan and your strategy mixes, then that certainly can have a place and is a sensible approach.
Okay, once you buy Bitcoin with retirement funds through crypto IRA, how use it in retirement without consuming the Bitcoin, so can pass down to family?
Not quite sure what this means. So I think what it's saying is if you have some Bitcoin in your IRA, how can you use it at the same time as passing it down? What I think they might be saying is whether your IRA allows you to take out a loan based upon the collateral of your IRA. That's a pretty sophisticated structure. But those options would be that may be available, but it all depends on your IRA provider. That may not qualify as an IRA allowable transaction. I wouldn't be able to answer that question without pulling in some relevant expertise in terms of one of the experts, like Sharon came along, and Sharon Yip is been an expert in the different structures that you together with in the US with particular. And so I would defer to someone to answer that very specific question. But it is a very, very specific question. It depends on your IRA provider. It depends upon the allowable transactions and whether you could do something like that. It might disqualify it from the tax benefits of an IRA. But that would certainly be something with a tax advisor to go through.
A question from Dean. Simon, you mentioned accumulating more Bitcoin each month, but also acquiring more each time the price crashes. How do you reconcile both of these statements?
So dollar cost averaging and compounding. And so I don't say when the market crashes, I buy more. I have a fixed strategy for accumulating. And so if the market goes up, you accumulate less Bitcoin. If the market goes down, you accumulate more Bitcoin. And you also have a compounding effect. And so that's exactly how we do that in the retirement plan B. And making sure that you always have more Bitcoin than the previous month.
Okay. Does your program match participants with vetted financial advisors and CPAs?
That's not something we do, no. We don't provide you with various CPAs. I bring my experts in, and we have the Retirement Plan B alumni community that all have different experiences in different jurisdictions. It's a very global community. And so they can share who they're using, their recommendations. And that was the real point in building the community, rather than, because every time we would mention one advisor, they would get completely maxed out and can no longer provide the service to all the people that are looking to receive that service. And so by having the Retirement Plan B community, where we're all on a common language, a common goal, a common understanding, then everyone can bring in their local experiences. And what happened last time is the people started to break out into different country-specific groups and share different contacts as well as they implement this together.
Okay, this I guess is going to be the final question from Renata. If you had 300,000 to invest, what would you do? I need to get them out as soon as they hit my bank accounts.
If I had 300,000 to invest, I would do exactly what I talked about in this masterclass. I would put it across the 5 different Bitcoin and crypto investing strategies. I would complete my financial plan, and I would have an allocation to Retirement Plan A, an allocation to the different buckets, and I would put it across these 5 different investment strategies and approaches. And in determining that, I would look at setting out some goals and putting together a structure so I could benefit. So I believe that that question is exactly what we've been answering in Masterclass 1, Masterclass 2, Masterclass 3, and we will continue to answer in Masterclass 4 when we put all this together. So we're about time. It was great to cover more questions. It really helps me to see where your head is at, so that when I'm designing Masterclass 4, which we're going to be going live with at the same time tomorrow, I can make sure that we're taking more of your questions and tailoring the content around the types of questions that you've given me. So We're now going to move over to those that are watching the recording. This will be pretty much the end of the broadcast. Hopefully, you'll be joining us tomorrow at Masterclass 4. This is the 5 Bitcoin investing strategies and how to create a cryptocurrency retirement plan. Think about the different things that we think about and the different processes. And so we'll be moving to Masterclass 4 at the same time tomorrow. And as a reward to give you a sneak peek inside the Retirement Plan Bee Online Wealth Management Program, as I said, we've got different modules here. You can see what it looks like. Underneath every video, you have comments. You go through the different section and we break it up into very logical, follow the things, download the spreadsheets, follow the steps. We've spent all the big money on all the big advisors so that you don't have to. So now we're going to give you a little sneak peek with Adam Vaziri, who's going to be going through the different things to consider when deciding who should own your retirement plan B, and a bit more on the thoughts behind the portfolio builder structure. So always remember, you are alive at one of the most interesting and exciting times in financial history. I hope the 3 masterclasses are going to make sure that you get yourself on the right side of the change, because some people are going to get hurt. And I hope that the more people that watch these masterclasses are going to immerse themselves, implement the things that are right for them, and get themselves on the right side of this change. So I didn't even ask you once. We got to the end of the masterclass. Do me a favor. If you enjoyed this, like it. Please do share it with all your friends and family that you think would enjoy this. Please do retweet it and tweet me on Twitter with your thoughts. We're going to go over now to the live viewer bonus with Adam Vaziri. So thanks everybody if you're watching the recording. And Dave, now play the video for the live viewers. Thank you.